Good afternoon, everyone. Welcome to second day of Western India Accounting Conference. Let us start our day with ICAI motto.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्द्वैता
CA Aniket Talati, the Central Council member of ICAI and the faculty of the session. CA Harit Dariwal, chairman of the branch of ICAI. CA Murtuza Kachwala, my council colleague in regional council, WRC of ICAI. CA Sunil Bhai Sanghvi, treasurer of the branch of ICAI. And all my dear participants, welcome all of you to the second day of Western India Accounting Conference. First of all, let me thank with my bottom of heart to each one of you for your overwhelming response to the first day. So during first day, we have excellent faculty like second day, where Sylvia from Europe has talked about very important things on the ECL, then accounting of gold, accounting of cryptocurrency, and other many important things. And plus, CCM MP Vijay Kumar ji has talked about the Schedule 3 amendments. Today, again, very important topics and extremely important faculties. To start with is on commonly observed errors in accounting standards. Before I roll upon the further, I would like to quote with from ICAI past president CAGP Kapadia ji. His words were, in discharging the duties and performing various functions, the paramount consideration which should weigh with the members of profession is that they are not merely performing particular duties to earn emoluments, but they have to discharge a wider function and their obligation a moral one. I think that is what a thought-provoking message by past president ICAI, and we should focus more on our duty as somebody with whom everybody is looking at a very high hope. Our reporting should be of the highest level and of the highest quality. So just to ensure and grant upon that, we do have with us the chairman of Financial Reporting Review Board, FRRB, C. Aniket Talati, to address on this. I request my council colleague, say Murtuza Kachwala, to share his views and also introduce the faculty.
Thank you, Chintan Bhai. At the outset, let me thank Chintan for organizing such a beautiful program under his committee, and really, like, the topics are so well covered and with such good faculties. Thank you. Really, it has come out quite well. I would also like to take this opportunity to thank Harit and the team Ahmedabad branch for the really splendid work. We talking about the fitness program, or like the vaccination drive, or like the food drive, or the CAP surveys, and the list can go on and on. And really, hats off to all of you guys for doing such a good work, and ably supported by all the 3 regional council member and the central council member Aniket Talati. Coming to Aniket Bhai, we've seen him really do a lot of good work, and at least on the digital side, I think ICAI has transformed a lot in the last few years, and a lot of things which we are looking at, from the SSB portal to the digitalization, and various other things which are happening. So like I think a lot of contribution even to the digital hub. So Aniket bhai, thank you really for the good work, and we see that like you've been putting in a lot of efforts. So thank you for all the good work. Now let me introduce Aniket bhai. So MCOM and FCA, he is a Central Council member currently. A man of refined thought process, quick understanding, and sharp vision. C. Aniket Sunil Talati is a Central Council member of the Institute for the term 19 to 22. Having served the profession for about a decade, he had been elected to the Ahmedabad branch for the term 2010 to 13 and 13 to 16. He was elected to the Western India Regional Council for the term 16-19. He has served as the youngest ever chairman of Ahmedabad branch for the year 2014-15 and as secretary WRC for the year 17-18. He is respected for his strong organizational skills and deep insight in the affairs of profession. C. Aniket Talati has contributed to the cause of profession from various professional perspectives in his past role. He heads the consulting vertical of his firm Talati and Talati LLP Chartered Accountant, one of the largest firms of Gujarat. He has led an engagement team of over 20 CS from New York every year to work on top real estate developers of USA. Being a Master of Commerce and Horticulture with Lovelock and Lewis, network firm of PwC, Aniket has developed a unique perspective to look into the matter. He has led the cause of profession through various committees of the branch and regional council. He is also chairman of Financial Reporting Review Board and convener of Digital Reengineering and Learning Directorate. He is also serving on Board of Studies, Digital Accounting and Assurance Board, Accounting Standards Board, Auditing and Assurance Standard Board, and Direct Tax Committee, among others. He is also Executive Committee member of Gujarat Chamber of Commerce and Industry. With a vision to patiently and clearly responding to the issues of image and identity of accounting profession in the country and abroad, C. Aniket Talati has a very keen eye and understanding of the matter. With his deep insight for the affairs of profession, he has always kept the profession on priority. A man of grassroots understanding of the matters and respected for his down-to-earth approach to the issues at hand among his professional colleagues. C. Aniket Talati has a surpassing ability to deal with a variety of difficult situations, and he is also thoroughly conversant with the professional concerns and demands of his times. Aniket has authored relevant books, including Treatise on RERA, published by CA Association Ahmedabad. An academic by temperament, Aniket has published numerous articles in newspapers, magazines, and professional newsletters, and delivered lectures in about 150 seminars and conferences. He also serves on the board on the governing council and executive committee of HL College of Commerce. So, friends, with that brief introduction, I hand over back to Chintan. Chintan, over to you.
Thank you so much, Murtuza bhai. I think what we speak for him is less, but I understand that the time is also very important thing. So, and we all are eager to really listen from him. The topic is actually one of the most relevant. And when you look at the accounts under non-compliances, so AS 15 is generally the first time employee benefits where I've seen the many non-compliances. AS 22 deferred tax, still it is a complex for the chartered accountants to follow. So I think many things are there. Still they are like it's like 15 years back the standards are issued, 20 years back the standards are issued, but still we are learning it. So let us, it's really very important for us to understand and ensure that we don't repeat the mistakes. We should learn from mistakes, and that is the main objective of this today's session. I request Aniket to take this charge.
Thank you so much, dear Chintan bhai, both my colleagues in the regional council, Chintan bhai and Murtuza bhai, the chairman of Ahmedabad branch, and very rightly mentioned by Murtuza bhai, who's leading from the front in these dystopian times that the entire city, and I can say the entire region, is going through. Harit bhai, kudos to you for all the efforts, all the initiatives that you are taking. Like I always say, he's a rank holder all throughout his chartered accountancy and always does wonderful academic programs. But I think what is heartening to see for all of us is also his equal amount of passion towards members and students in all the other activities that Murtuza bhai has mentioned. So I think the region as a whole, under Manish bhai's leadership, and of course Harit bhai at the branch level, Sunil bhai the treasurer, are doing excellent work and ably guided by Chintan bhai, Vikas bhai, and Nitesh bhai, the three regional council members. Thank you very much for giving me this opportunity, and very rightly, I think Chintan Bhai has set the tone that even today, after maybe AS 15, I remember during my articleship almost 15, 17 years ago, the AS 15 was revised and I did in the early implementation. The other AS 22 and other standards have almost been there for 20, 25 years. And even, having said that, so many times when one looks at financial statements of non-corporate entities or corporate entities to whom Ind AS is not applicable, these are all errors which one sees. And I think one important myth that Chintan Bhai has tried to break in this session of 2 days that WRC has organized is that standards are actually not a burden. We always take standards as something that, oh, it's a compliance. What better example than this Corona times when all of us has realized the importance of safety standards. We never thought we will be wearing masks. Now I'm seeing all chartered accountants wear 2 masks. You are adopting to these safety standards because your life is precious. The life of your family members is precious. We are sanitizing our hands. Maybe 1 year ago, 90% of us did not know the concept of a sanitizer or even the terms such as remdesivir, oxygen concentrator. We have learned science terms. We call each other and ask how much is CRP, how much is D-dimer, how much is your CT value. Great keen interest we are showing in the science profession, the medical profession. But my request with folded hands is, let's also have the same curiosity for not the safety standards only, but also our accounting and audit standards, because your safety standards are saving your physical health. Trust me, believe me, your compliance with accounting and audit standards will increase your financial health, will protect your not just financial health, but the entire image of your professional being over the years, decades that you have built up. Because God forbid, if one of the financial statements that was attested by any one of us and it gets selected for, let's say, additional review by NFRA, by any government agency or by the investigating agencies, in that scenario it will be extremely difficult that you will not be able to then justify your efforts. So therefore these standards are there to protect you. These standards are there to ensure that tomorrow whenever your professional work of issuing an opinion comes into question, you can state that yes, I have complied and followed the standards that ICAI has issued. So let's start this session with a very clear understanding that standards is not a burden. Standards are there to help us, aid us, assist us. Having said that, let me take you through then what is the FRRB, what is the role of FRRB, and then some very common errors that the board has been noticing. And again, let's change the perception of FRRB. I always say this as chairman of the board, it is not the role of FRRB to pull up chartered accountants to punish them and put a gun to their head. In fact, both boards, the peer review board and the FRRB, are the first line of defense for all chartered accountants, because it is your own alma mater, your own mother institute, which is reviewing your work, which can then compare what you have done, and in case certain shortcomings are there, guide you. So let's understand what the FRRB is doing. It was incorporated in 2002 and it's a very important wing of the ICAI. And for the second year running, I have been given the responsibility of chairing this board. The board functions totally independently. It has members of Central Council. So there are my council colleagues who are on the board. Along with that, we have nominees from SEBI, C&AG, IRDA, CBDT and other boards that we invite. And you'll be surprised, a lot of these nominees, the C&AG, IRDA nominees, besides the government nominees who are already on the council and are part of the board, they attend these meetings extremely regularly. They are reviewing the work that we all are doing as chartered accountants. And you will all be surprised to note that the board is functioning so independently that no member of the disciplinary mechanism is a part of the board. Even our president and vice president, if you look at the constitution of committees of ICAI, they are ex officio members of all the committees of ICAI. But FRRB is the board where neither the president nor the vice president are ex officio members. That is the importance given to FRRB. And what does FRRB review? The FRRB selects financial statements, and believe me, it's a very fair, transparent process. It cannot be that tomorrow I want to select 2 companies of Chintan Bhai, 1 company of Harit Bhai, maybe some of you participants, I don't want to just take names, and I select your company and we review it. No, it's totally independent selection of companies that happens on an annual basis. Whichever balance sheets of listed entities are picked up, their review is done and compliance is verified with the accounting standards. So for example, Chintan Bhai mentioned AS 15, AS 22, other accounting standards, whether you are complying with them or not. Your audit standards, your standards in auditing. For example, going concern, SA 560 in certain circumstances says you have to qualify the opinion. The director's report is stating that the future of the company is bleak. The net worth based on the balance sheet is eroded. There are continuous losses that you can see in the P&L. The cash flow has no operating loss. And still the auditor does not say anything about going concern and simply says accounts are prepared on as-is basis. These are all then verified qua the accounting and auditing standards. Your report, that is the audit report, whether it is as per SS 700 or not. Some of you will recollect the opinion para has moved on top. SS 701 for CAMs was made mandatory last year. So whether those standards are being complied in the audit report. The guidance notes which the institute has issued on Schedule 2 and Schedule 3. And today I am not covering Schedule 3 non-compliances because I'm aware MPV took you through them in yesterday's session. We also verify whether you've complied with all the industry related guidance notes, because guidance notes don't recommendatory in nature. If you go through the authority attached to the documents of institute as approved by the council, it clearly states that guidance notes are recommendatory, but deviation has to be only in particular cases and it has to be justifiable, or else guidance notes are mandatory to that aspect. So therefore we verify whether you've adhered to the requirement of the guidance notes. If there are any expert advisory opinions specific to that transaction, and here to all the participants who are either preparers of financial statements or giving an opinion as auditors on these financial statements. I always say this, for majority of the times that we are doing this work, there is very little invention. Invention is done by scientists and by professors and others. In our field, very few opportunities will be there where you will come across an extremely unique situation. It may be unique based on your professional experience, but in the past 70 years of our profession, there are good chances that something of this nature would have happened in the past, and some company would have gone through this dilemma that you are in and taken an expert advisory opinion from the institute. So very important publications. We have almost 30 expert advisory opinion compendium volumes which are published. You can download them. You can buy them from the portal of the institute. You can keep the soft copy. And whenever you have an accounting dilemma, please refer to these expert advisory opinions. Even us at the board, we are ensuring that if there is a particular accounting treatment on which the expert advisory opinion has been given, then whether it is the same case and what is the treatment that you have done. So the standards, the accounting standards, the auditing standards, the guidance notes, the industry specific guidance notes, the expert advisory opinions, the ITFG bulletins, which the India's implementation committee in the past has issued for all these years, the RBI master circulars. For example, we are looking at a balance sheet and 45IA on the apparent, looking at both the P&L and balance sheet is clear. All income is dividend income or profit from sale of shares income. The balance sheet is totally loaded with investments of shares, derivatives and the likes. It is very clear that then 45IA may be applicable. But if in the CARO report or the audit report no such clarification is made by the auditor, then the FRRB will review it. We also review the implementation and educational material issued on Ind AS and on the essays. So all of these documents which are issued by the institute, extremely important. I would urge all of you, always refer to them. If possible, try and keep a copy of them in your office, and whichever is the audit engagement team or the team which is preparing financial statements, ensure that they are going through all this content so you don't end up reinventing the wheel. And if there are any specific issues which crop up during your audit or your preparation, you can refer to these publications. Based on this background that I've given to you, so far the FRRB has done close to 1000 cases. That is 956 exact number of cases till last year, out of which 76 were suo motu. So sample selection, like I said, totally independent, non-biased. 24%, so 1/4 of the cases that FRRB does, they are special cases. And what do I mean by special cases? Where either a regulator, example MCA, C&AG, IBBI, they have given us and referred a balance sheet saying this balance sheet doesn't look correct to us. Or newspaper reports where the institute is of the opinion that no, these balance sheets, these financial statements need a thorough review. There are apparent non-compliances of standards on the face of it. Those are also reviewed on special case basis. So 1/4 of our work is on such special cases. Out of these, 17% cases. So on an average, if in a year we are doing, let's say, 100 cases, 15 to 20 cases get referred to the director discipline. And these are cases where we have noticed that there is a huge difference in true and fair view. For example, the entire balance sheet was showing profit. Had the standards been complied with, had the treatment been in line with accounting standards, the entire profit would have turned to loss. So in such a huge scenario, where in fact the true and fair view itself gets distorted, in those cases, the board has to refer the cases to director discipline. If we find that yes, there are errors, but there is no such huge differentiation of the true and fair view or the impairment of the view, or we find that yes, the material amount is not there, in such cases, the cases are sent to as an advisory to the auditor. So the auditor is given an advisory, and for some cases where no such non-compliances are noticed, and there are, I must compliment all of you who are attending. Many of companies that we review, the preparers and the auditors both need to be complimented in such cases where we have reviewed and this balance sheets are, there are no such issues which require either an advisory or to take up as disciplinary action. Whenever we take up the cases for disciplinary, you can see the first point here. There, not only do we refer the auditor to the disciplinary committee mechanism of, let's say, any errors in the audit report or any non-compliance of accounting standards, we also ensure that the company's balance sheet is brought to the attention of the regulator. So it may be the MCA, it may be SEBI, it may be IRDA or RBI, if it's a bank or an insurance company, and the regulator is also told that financial statements is the responsibility of the management, and in this case, this company, these standards have been totally ignored and not complied with. So for every case that we take, it can either go through the disciplinary committee and regulator reference, or there can be an advisory that is issued to the auditors. Majority of the cases we are issuing advisory, because I truly believe that the role of FRRB is not just to punish our chartered accountants, that can be in the rare cases, but to bring to the attention if there are genuine non-compliances or errors happening, which may not be intentional, but have a material impact to a certain extent. In those cases, we are informing the auditors that in the form of an advisory that here we noticed non-compliances. And accumulating all these non-compliances, we are doing what are the awareness programs such as one today, and also releasing publications. What are the publications? You can see it on your screen. 3 volumes that have been published with relation to the accounting standards. So, compliance of financial reporting requirements, 3 different volumes which discuss the accounting standard non-compliances. These are what we are going to discuss today. The accounting standards which Chintan Bhai mentioned are in vogue since almost 20-25 years. Still, even today we are seeing in a lot of companies which may not be Ind AS, for example, banks, insurance companies, other companies which are group companies, but to them whom Ind AS is not applicable. For all such companies, even today, a lot of non-compliances. And based on the audience that I have been informed, I will like to touch upon more of these non-compliances with regards to the accounting standards and not so much with regards to the Ind AS. But extremely happy to share once again that last year in February, we had published this first ever study on the compliance framework under the Ind AS. Nowhere in the world is such a publication ever been issued. Ind AS, as you are aware, barring those 10-13 carve-outs, is identical to the IFRS. But there are no publications available internationally which tell you what common mistakes or common errors are being made in financial statements in this framework. And this publication, which is issued by the board, it is available for download on the ICAI website. It is available as a physical copy on the CDS portal. You can order it, and a very good publication which deals with Ind AS non-compliances that the FRRB board over the past 2 years, because we have only reviewed now Ind AS companies for 2 years. This is going to be the 3rd year. So based on the 2-year reviews that we did, we have brought out some common errors that are being made in financial statements with the sole objective that participants that are here like today, either preparers of financial statements or auditors issuing an opinion on these financial statements, they can get an understanding of what are the errors that are happening in financial statements. And if they are also making these errors, they can rectify them, because in Gujarati and Hindi there is a saying, Jagya Tyarthi Sawar, jab uthe tab se subah hui. So if you have realized today, improve upon it and start implementing that. Yes, these non-compliances which the board has noticed, even we are doing in our balance sheet. Now we want to improve and ensure in going forward in the future, these errors are not happening. So I have been trying to give you a broad understanding of the functioning of the FRRB, what the role FRRB is playing, how we are reviewing financial statements against and the compliance of it vis-a-vis accounting standards, standards on auditing, vis-a-vis the guidance notes and the industry specific guidance notes, the expert advisory opinions, the other publications in the form of educational materials, background materials of Ind AS and standards on auditing, and also with regards to the ITFG bulletins that are issued by the Ind AS Compliance Committee. And based on this, like I said, only in rare cases are cases referred to the director discipline or to the regulators where the matters are referred. In other cases, an advisory is issued to the auditors, and all such non-compliances which we have noticed in the board, we have come out with these publications, 3 in case of accounting standards, 1 in case of the Ind AS framework, where common pitfalls and errors our chartered accountant colleagues either as preparers or as auditors are making. So let's try and now go through non-compliances. I'll share with you what is the percentage of non-compliance, what are the most common non-compliances, and would request all of you, either who are working in industry and are preparers, or those who are auditors and issuing an opinion on financial statement, if you are making these errors, try and rectify them going forward. The first one that I would like to discuss today is the AS1, Basic Accounting Standard, which deals with the disclosure of accounting policies. In fact, even in the income tax section 145, this is the first standard that was notified years ago, a very common standard. The expectation is that whenever a financial statement is issued, it must always be accompanied by the accounting policies. Why? Because you may know as the auditor how the company is recognizing revenue, expenses, assets, liabilities. The company's management may know it, but any other person who's going to rely on the financial, a bank which is going to extend credit facilities, a shareholder who may invest his money into the company, a creditors who is going to give goods or supply services to this organization, they must also realize and understand, looking at the set of financials, how you have recognized each item on the balance sheet or the P&L. Therefore, a very important standard. You will be surprised even now, one has seen for small entities, people prepare balance sheet P&L and some are not even disclosing accounting policies. Most unacceptable error. Please always ensure notes are there and the accounting policies are very clearly disclosed. What is the main non-compliance that we are seeing here? Of two major types. The nature of accounting policies as required under para 11, there is non-compliance, and there is a huge non-compliance with para 24, which deals with the main principles, the crux, the heart of AS1. And what is that? Even now, and you will all agree if you look at certain financial statements, that certain companies omit to disclose significant accounting policies with regards to the following items. Borrowing cost. If you ask the auditor and the management why there is no accounting policy on borrowing cost, two things that you can expect to hear as an answer. The first may be, well, in this year there is no capitalization of interest that has happened. There is no qualifying asset, and therefore borrowing cost was not applicable to us, so we have not mentioned. Another can be, well, we are a totally debt-free company, and therefore we have not said what we will do with the borrowing cost. Now, for all these items that are listed in front of you, borrowing cost, valuation of inventories, accounting for investments, employee benefits, accounting for taxes on income, impairment of assets, and provisions and contingent liabilities. I will discuss for each what logic is given, and then we will discuss what is the requirement of para 24. Certain companies do not give an inventory valuation accounting policy, stating at year end we had no inventory and therefore no requirement of valuation of inventories, disclosure of accounting policy. Accounting for investments. Again, some companies mention, no, for 2 to 5 years we have not done any investment activity, so therefore no need for us to mention how we will account for investment. Employee benefits. We are not having any retirement benefit as such, or the number of employees is very limited, and therefore yes, 15 is not applicable to me. Accounting for taxes in income, people will say, no, there was no deferred tax impact, no 43B, and I don't know how without depreciation difference may not be there, but people may say, no, there is no depreciation and therefore no deferred tax. No impairment, all our assets are valued perfectly. In fact, condition is so wonderful that I can sell it today. The asset, if I sell it in the market, I will fetch more than the book value. So where is the question of impairment? And I am not making any provisions. These are all explanations or the vague understanding of the standards that people have. I request you with folded hands, it is not to be seen qua the year that you are doing audit or the year for which you are preparing the financial statement. Borrowing cost. You may not have a case of capitalization of interest cost, but if there is an interest expense debited to P&L, this standard does not only deal with capitalization of interest. you also have to mention how interest expense, which in a lot of companies is a huge amount, how you are dealing with that. Yes, it is on accrual basis, and you are booking the interest expense up to 31st of March. But the fact that that is how you're recognizing it should be mentioned. If the interest has to be accrued for certain loans, the lender may not have charged you. In the case of banks, of course, it will be charged. But for a third-party lender, it may not have been charged to you. But a sufficient provision for the interest expense as per the loan agreement will have to be made. And that fact that interest expense has been accrued and up to 31st of March has been accounted, that is a part of your policy. So ensure that borrowing cost, you are covering not just the borrowing cost which is capitalized, but also discussing about the borrowing cost which is hitting the P&L in the form of an interest expense. Valuation of inventories. You will not have an inventory at the year end, but the policy is for the year, and therefore if there was a time during the year when you purchased the inventory and sold it, it requires you to have a policy which states how you have accounted for inventories. What mistakes people are making in AS2 we will discuss in the next slides. But if let's say you did a purchase of 60 crores and did a sale of 65 crores and there is no inventory, there was only one transaction, yet though during the year there was an inventorization of your goods, you will have to give a valuation accounting policy. Accounting for investments, current investments, non-current investments, how you are accounting for them. What is the basis on which they are recorded and the carrying value that you are showing in the books of account, that will have to be disclosed. Biggest example is employee benefits. The standard before 2007 discussed and was named as retirement benefits. Many even today think that AS15 means retirement benefits. It was changed. It is now employee benefits. So there are short-term employee benefits and long-term employee benefits. What are short-term employee benefits? Your salaries, bonus, DA, other expenses that you are paying on a month-to-month or annual basis, those are employee benefits of a short term. Please mention how you are accounting. For long-term employee benefits, it can be a defined contribution plan or a defined benefit plan. Then if it is applicable and the number is there, mention that. If it is not applicable, you do not have such a plan, mention the fact that the company does not have a defined benefit obligation or a defined contribution plan. But what do a lot of companies that one has reviewed does? Don't mention even an accounting policy for that. No. Mention the short-term employee benefits, the salary expenses, other expenses, how you are accounting for. And for the long-term benefits in the nature of the contribution funds, what is the treatment? And if it is not there, there are no such plans, the fact that there is no contribution plan or it is not applicable should also be disclosed. Accounting for taxes on income. It is not just deferred tax. How you are accounting income tax and deferred tax, the AS22 which Chintan Bhai spoke about, both have to be mentioned. And highest non-compliances even today one is seeing in AS15 and AS22. In fact, it is with this experience that the council in the previous council meeting has decided to now divide the categorization of non-corporate entities, because for corporate entities it will require the MCS consent, but for non-corporate entities this has already been made applicable. You now have 4 levels based on the MSME definition. There, of course, the terminology was investment in plant and machinery, which has been substituted to borrowings. So the limit that we are seeing for applicability of the level in which the organization will fall are similar to that of the MSME. Based on that, if your turnover is below 2 crores, for example, for those small entities, below 5 crores, I apologize, in those entities which will now be the level 4 entities, there we have very simplified the applicability of AS15 and 22. Understanding very well that yes, even today members are making mistakes in employee benefit categorization and AS22, that is deferred tax, and some standards are not at all made applicable, and therefore for these very small entities, a limited set of accounting standards are applicable, and therefore this change with regards to non-corporate entities has been made effect. Please visit the institute's website. You can find what are now the revised levels and which standard is applicable to which entity. This change has been brought about to benefit our members so that you are not bogged down by the challenge of all the accounting standards that have to be complied with. Even we understand that for small entities, the fees are very limited, the work is limited. There may not be too many external agencies who are depending on that financial statement because banks, other agencies may not be involved. And it's only prepared for the limited income tax and GST purpose. So for those, this has been revised. Please go through the institute website for the revised applicability of accounting standard for non-corporate entities. So AS 22, impairment of assets. Again, people say there is no impairment expense in my books and therefore no need to disclose the accounting policy. No, sir. What you must state in your accounting policy is the company has a robust accounting policy to measure for impairment. What the standard expects that the management and the organization must on an annual basis on the reporting date look at the value of the carrying value of the fixed asset. You may have a machinery which is in the books for 20 crores, but if it is going to be disposed of tomorrow and sold in the market, let's say it realizes only 10 crores, and the product that it was making is now so redundant that there will not be sufficient cash flows in the future discounted to its present value that justify the 20 crore, then you will do an impairment. In those cases also, one has seen that impairment is not even done by a lot of managements, and auditors sadly in some cases have not even commented why impairment, and we have seen huge value of fixed asset carried in the books of account. Here, please test for impairment as auditors. In case there is no requirement of impairment, that is to say you tested for impairment, the value of carrying value of the asset in the books to accounts or in the balance sheet is appropriate. You feel that yes, it is correct. I will justify the future cash flows from this asset, which will be enough to justify this valuation. Or if I sell it in the open market, I will realize enough funds. Then you may not book impairment. But the fact that the assets have been tested for impairment and that the company has a policy that on an annual basis or regular basis they are testing assets for impairment, that fact must be mentioned. Similarly, this year there may not be a provision requirement, but it may not that current year is the only year for which you are reporting. Provisions may be required, may have been done in the prior years, may be done subsequently, and therefore a policy of how provisions are done, how you recognize contingent liabilities and contingent assets, that must be disclosed. So I hope all of you are making notes of these basic standards. Again, notes are not qua standards, but these are basic items on the balance sheet and P&L for which a note to account, in the notes to accounts, the disclosure of accounting policy, such disclosures must be there, because para 24 of AS1 very clearly says that all significant policies adopted in the preparation and presentation of financial statements should be disclosed. Therefore, each of these must be separately covered because they are impacting your preparation and presentation. Your fixed assets value is correct, subject to depreciation that has been provided. It is not to be impaired, and the fact that it is not to be impaired and impairment testing is done will have to be disclosed, for example, in the accounting policy for impairment of assets. So I hope all of you are following this very basic disclosure requirement, and where there are errors which one is noticing on. Another common error that I can share with you with regards to the AS1, in one of the annual reports, the notes to account mention unrealized loss on outstanding derivative contracts. So there is a derivative transaction and there is an unrealized loss. this has not been done, considering principles of prudence. Sometimes such notes are found in financial statements. Standards are not to be complied with, guidance notes are not to be complied with. So people will say based on prudence, based on consistent accounting practice and policies adopted by the organization, and such terms are used. No, very clear as per AS 1 para 17, prudence is very clear. It says you cannot recognize future expected profits, but future expected losses must be recognized. The age-old principle of conservatism is imbibed in para 17 of AS 1. Another example, subsidies granted by government for providing, here, of course, because we have selected it from our observations, it says telecom services, but you can conceptualize and visualize this for any company where government grants are received, are recognized as other operating income in accordance with relevant terms and conditions of schemes and arrangements. Now, how can you expect the reader of the financial statement to say relevant terms and conditions of scheme and arrangement? The user of the financial statement, the FRRB, for example, and tomorrow, let's say if some other regulator or investigation agency verifies this, how do they have an understanding of the terms, conditions, schemes of arrangement? It is practically not possible. Your notes must be such that it is clear. What is the timing of recognition of grant? That has to be very clearly and explicitly given in the notes in the form of the disclosure of accounting policy. So my request to all participants, let's avoid jargon. Let's try and avoid English, which makes the accounting policy difficult to understand. But the clear objective, in fact, must be presentable and understood easily by the readers of the financial statements. So these are common non-compliances vis-a-vis AS1. We will now move on to AS2. Again, one of the highest number of non-compliances that one has seen even today are with regards to the AS2. And what are the non-compliances? Well, the most common ones deal with the measurement and the disclosure. As you are aware, the standards talk about how do you measure an item, what are you supposed to disclose it. In both these paragraphs, huge amount of non-compliances besides the cost formula. What has been applied? A lot of accounting policies don't mention it, and other non-compliances. Let me now bring you to certain examples. Here, if you look at the observation paragraph, you will see some extracts of the notes to accounts where valuation of inventories has been described in the annual reports. I'll just read one or two. For example, stock of cards are valued at cost and on FIFO basis. Some places, what do we mention? Inventory is valued at cost or market value. You will see some of the examples at the bottom. Work in process is valued at raw material cost. It is measured at average cost. Here, it is very clear. You have to not mention that it has been on cost. It has to be cost or NRV, whichever is lower, net realizable value. And here again, dear colleagues, the terminology in the standard and the expectation is to use net realizable value. Market value is different. NRV, that is net realizable value, is different. Please do not make this error of simply stating inventory is valued at lower of cost or market value. It is not appropriate. You must use the terminology net realizable value. Another example that I can give you with regards to the AS2, people will simply mention inventories is valued at cost or NRV, whichever is lower, and put a full stop. It is not mentioned on what cost formulae have you arrived the inventory, whether the entity is using weighted average cost or it is using the FIFO basis. Cost formulae will obviously always have to be disclosed as a part of your AS2. So next time, even for the smallest entities that you are either preparing the financial statements for or giving an opinion in the form of an audit report, of the financial statements, please ensure that you are using the terms NRV, not market value, and the cost formula applied by the organization. In case of tally, if it is done by FIFO basis, mentioned it was done by FIFO. In case of weighted average, mention it. And simply putting in the bracket verified by management, that is not appropriate also. That does not absolve us even by 0.001% of our responsibility. Whatever is expected out of us as chartered accountants in practice and as auditors, it is our solemn duty to do the procedures as required under the standards of auditing, to comment on any non-compliances with the accounting standard. So by putting into bracket as valued and certified by management is not absolving us of any responsibility. In the audit report itself, you are stating the financial statements are the responsibility of the management. So yes, the inventory is of the management. But by saying that the valuation is as certified by management, no, as an auditor, you must be certified and be reasonably sure that there is no material misstatement and the inventory valuation is something which is comfortable to you, and only then should you sign it, or suitable amendments or modifications in the audit report as required under SS 705 ought to be made. So NRV, cost formulae, don't mention as valued and certified by management. These are some common errors with regards to AS2. There are a lot of other errors which are published in these publications. If you are keen to understand other errors with regards to these standards, I would encourage you to please go through the publications and try and pick up the non-compliances standard by standard that you can get there. We will now move to AS3. I'll try and be a little quick in the time because we have 30 minutes to go before we hand over the session, but I'll try and cover all important non-compliances with regards to the accounting standards. We've discussed accounting policy, we've discussed inventory. Now another standard where lot of errors are being noticed, lot of mistakes that are being noticed is with the cash flow statement. In one of the cash flow statements in the annual report, it has been noted that decrease in investment, and this is a bank. Decrease in the investment was disclosed under the head cash flow from operating activities, and under the note on investment, such investments also included HTM, that is held to maturity investments. The para 5.4 and 5.5 of AS3 is very clear. If the investment is available for sale and held for trading, not HTM, that is held to maturity, they are held for trading, then and then only should they be categorized as cash flow from operating activity. Even for a bank, if the investments is HTM, that is held to maturity, then they are not to be considered as a cash flow for revenue generating activity. They will not be in cash flow from operating activity column, but will have to form a part of cash flow from investing activity. Even if it is bank, HTM investments are cash flow from investing and not cash flow from operating activity. As participants are largely from Gujarat and Maharashtra, if you are doing cooperative banks, please be very careful. In a lot of cooperative banks that the FRRB is selecting for review, we are seeing such errors, and therefore I thought it appropriate to bring it up in this forum. Again, certain non-compliances with relating to the AS3 in the notes to administrative and other expenses. So when we are reviewing the financials, don't think that we are not looking and cross-tallying every item. We have, in one of the examples, the board found that in the administrative and other expenses schedule of the profit and loss account, there is one item, exchange fluctuation net, amounting to so much. So it is given in the P&L debit, but it was not adjusted in determining the cash flow from operating activity. As you are aware, this entire amount has to be clearly separately adjusted in the profit, in the cash flow from operating activity section. So please be very careful and try and agree the amount as per P&L, the exchange difference, and ensure it is also reflected in the AS3 statement. In fact, many of you will be surprised, but there are cash flow statements one has seen where cash and cash equivalent as per balance sheet, and that is a closing balance, and cash and cash equivalent as per the cash flow, those also do not tally. I am aware now in the XBRL filing, of course, the filing when you do for MCA, lot of people realize at that moment, oh, I made this mistake, and they go and change the amount in the XBRL file balance sheet so that the XBRL compliance and the MCA compliance is done. But the signed balance sheet, which is scanned and attached, in that the difference is there between the closing cash and cash equivalent as per balance sheet and as per cash flow. One of the most glaring but very common errors that is noticed, and I'm not talking about rounding errors, there is substantial differences also that one has seen. Again, changes in exchange rates have to be reported as a part of the reconciliation in the cash and cash equivalents. Many annual reports are not complying with this. Again, one very common error, interest is reported on a net basis in the financial statement. And in the cash flow also, the management may have multiple reasons, ulterior motives to do this. But as auditors, we must be clear and categorical that interest expense cannot be shown as a net expense, net item on the cash flow statement. Cash flows, the interest income will have to be as a part of your investment activity, and whatever is your regular interest expense, if it is due to financing activity, then it must go there. You cannot net it off and show the net amount only under the head of financing activity. Your investing activity and your financing activity have to be separately shown in the cash flow. Again, I'm trying to take you through most common non-compliances because we will have to complete these sessions on time. Needless to add, I will be sharing the entire presentation with the WRC and will be happy to get it circulated to all the participants. Again, one of the common errors with regards to the cash flow statement of a finance company, that changes in borrowings were disclosed as cash flow from operating activity. The para 17 of AS3 very clearly states that cash flow on account of borrowings in case of all enterprises, whether NBFC, financial, bank, non-bank, they have to be presented as cash flow from financing activity, because the definition of financing activity in AS3, there is no distinction for a financial company or a non-financial company. So bank, NBFC or a regular manufacturing or trading concern, they all will have to show this in the financial activities column only. In one of the cases, fixed asset lost due to robbery was shown in the cash flow. Now, very clear and apparent, this is a non-cash expense, and the cash flow has no room whatsoever to incorporate any such non-cash expenses, because para 40 of the AS3 very clearly states that non-cash expenses are to be excluded from the cash flow statement. So these are all some very common errors that one has seen with regards to the AS3. We will now move on to again AS4. Not many errors noticed here, but this deals with the contingencies and events occurring after the balance sheet date. As you're aware, it can be an adjusting event or a non-adjusting event. One common error that we have seen in one of these cases was that in the notes to accounts, company policy, what did it mention? That we have taken into account impact of any significant event that occurs after balance sheet date but before finalization of accounts. The word used was finalization of accounts. Now, how can any reader of the financial statement, bank, shareholder, SEBI, MCA, FRRB, ICAI, anybody, or the disciplinary committee, understand what do you mean by finalization of accounts? That date can be anything. You can say, no, we finalized the accounts in May, but then we signed in September. So that should not be stated. It has to be very clear that you have to state until the date of signing of the auditor's report. That is the requirement of para 3.2 of AS4. Up to the date of signing of your report, you must do your events occurring after the balance sheet date, that is the subsequent events, and if there is an adjusting event, then you will have to give effect to that in your financial statements. 4 is done. 5, not many errors. 6, as you are aware, is not applicable. 7 deals with construction contract. Here again, in the case of any construction contract, what is being given in one of the cases was job work revenue is accounted on the basis of running bills, which are referred to as RA bills, raised and approved by clients. Revenue expenditure is accounted on accrual basis. Now, if you go through para 21 of AS7, it requires both revenue and cost to be accounted on the basis of the stage of completion of contract. So you have the contract cost, you have the contract revenue, and you have the percentage completion. Based on the percentage of work completed, only on that percentage basis should a revenue and cost be recognized. Such accounting policy that RA bill was raised and RA bill, on the basis of RA bills you have recognized your revenue, it is not acceptable as an accounting policy. You will have to follow AS7. In another company annual report, it is involved in construction business. It has a schedule of inventory and there is a job in progress. However, there is no disclosure made in the financial statement. In such cases, where you are involved in the construction business, you will have to give, as per para 39 of AS7, the aggregate amount of cost incurred and recognized profits up to the reporting date. These are all disclosure requirements compulsory to be mentioned. The amount of advances received. So what is the amount of advance that you have received till date? Those will have to be disclosed. And if there is any retention amount involved, that will also have to be disclosed. Those are some non-compliances that one has seen in applicability of AS7. AS9, which deals with revenue recognition. The maximum non-compliances are with regards to the para 10 to 13, which deal with the main principles. Giving you a couple of examples for our better understanding. Revenue of sale of tickets is recognized when the tickets have been sold. Advertisement revenue is recognized when advertisements and net realizations are confirmed. Clear-cut case, how can you recognize revenue when you sell the tickets? I'll give you a live example. Ahmedabad, there was the England-India tournament. Tickets were sold for all matches, and in the middle they had to cancel the ODI, and the amounts were refunded to all the people who could not attend. In such case, it is very clear that in case of advance booking of tickets, there is always a time gap between the sale and the actual event. So revenue cannot be considered to be earned until and unless the event has taken place. You can only recognize sale on tickets as per, you cannot recognize as per this on the basis of the date of sale. You will have to recognize it as per AS9, because if the event doesn't take place, like the example of the cricket match I gave you, then you will have to refund the amount. Even in the case of advertisement, you have the same principle. If you have received the income, but it can only be recognized once the advertisement is accepted and not simply on the realization of bills. You are violating the principles of AS9. Another common error, and especially in today's time when we are all learning, education, everything is happening online. One of the company's annual reports states revenue from online education services is recognized upon receipt of subscription fees. So you received for the full year today and you recognized it. It is very clear, violative of 7.1 para of AS9. Your subscription fee has to be recognized on a time proportion basis, and you apportion it over the service period. So if you have taken school fees or any education online fees and agreed to give a contract of or a service of 6 months, that is your contract period or a service period, and only 2 months are in the financial year 2021, then you can only recognize that portion of revenue that has been received. balance 4 months cannot be recognized as revenue. You will have to carry it forward and you cannot recognize the revenue. That item goes to the balance sheet. Yet one is seeing such kind of non-compliances in the financial statements. In case of an insurance company, insurance claim was recognized by the company simply on the basis of filing of the claim with the insurance company. Here it is violative of para 4.1 and 9.2 of AS9. Recognizing insurance claim at the time of filing of the claim is without considering the uncertainty relating to measurability, because the insurance company may or may not acknowledge the claim and the claim may not be settled for the amount that you have filed with. So therefore revenue has to be recognized, as the AS9 says, in the case of sale of goods or rendering of services. It has to be once the amount is reliably measured and it is not unreasonable to expect ultimate collection. So amount must be reliably be measured, it must be realizable, and it must not be unrealizable to expect the collection. Risk and rewards must be transferred, as you are aware, that is the crux of AS9. The amount must be realizable, it is measurable, and not unreasonable to expect ultimate collection. In the case of insurance claim, ultimate collection is very much in doubt. The claim may be settled at a different amount, and therefore very important for us to understand how you write the accounting policy and how you recognize revenue in such cases. Some companies have mentioned dividend is accounted as and when received. Income is recognized on accrual except dividend on shares of mutual fund, which are recognized on cash basis. Now these are all not as per AS9. It requires you have to recognize dividend when the right to receive is established. This business of saying as per cash basis is violative of AS9. It can only be when the right to receive the dividend is established. That is, once the company is approved in the AGM, then you may recognize the revenue. Similar other common that I have tried to mention here in terms of the voice is echoing. Lalit ji, if you can, yeah. Okay, I believe the next panelists have joined the meeting and therefore there was a echoing of the sound. So yes, with relation to AS9, these are the important non-compliances that I just thought I will draw to your attention. Again, like I mentioned, the entire presentation will be shared with you. AS11 deals with the effects of changes in foreign exchange rates. Here again, majority are relating to the reporting of subsequent balance sheet date items. I'll give you a couple of examples. Here, notes to accounts in the annual report of the company, there were foreign exchange transactions very clearly noted. Yet, in the entire profit and loss account, there is no exchange gain, no exchange loss, and there is no account of foreign exchange fluctuation. This cannot happen. Clearly violative that the company has simply recognized when the money came in the bank, recognized in INR, when the amount is paid out of the bank, recognized in INR, and not even accounted for the foreign exchange. In one of the cases, it was noted that the export sales have been recorded at the rate notified by the customs for invoice purposes. Now, export sales being recorded at the rate notified by customs is not correct. It has to be translated. You have to translate the same on the basis of exchange rate prevailing on the date of the transaction. So when the transaction has occurred, on that date, what is the reference rate between the foreign exchange? That will have to be used for recording the transaction. In one of the accounting policies in the financial statement, current assets and liabilities at the end of the year were translated at the exchange rate ruling on the balance sheet date. So these are current asset items. That means they are monetary items. For monetary items, you are required to translate at the closing rate, and not all foreign currency assets liabilities, which may include non-monetary assets liabilities as well. So your entire current assets may not be monetary. There may be non-monetary items as well. Therefore, just simply converting them at the year-end rate for all is not the correct application of AS 11. I will now move on to AS 15. 12 deals with government grants. 13 investments we've already discussed with regards to the current investment and the notes to accounts when we discussed AS 1. AS 15, Chintan Bhai also mentioned at the start, one of the most common errors are noticed with regards to the AS 15. For example, in one of the companies, the accounting policy simply states that annual contribution in respect to PF are made to LIC and are counted on accrual basis. This is violative of para 45 of AS 15. Expenses of defined contribution plan should be recognized for each period of service rendered by the employees. So for every year that an employee has been engaged and employed by you, for that it has to be recognized, that proportion of expense has to be recognized, and it cannot be on the basis of the contribution that you are making to the fund. So if you have 100 employees, and for those 100 employees there is, let's say, a retirement benefit that will have to be paid, whatever expense for those 100 employees which is relatable to this financial year, that is what the standard calls as the service period of 1920 or 2021, that amount has to be debited to P&L on the basis of course, actual valuation. It cannot be simply on the cash or a payment basis that you are making to the fund. That is not the expense that must be debited to profit and loss account. The entire working of AS 15 and retirement benefits ought to have been done on the basis of the standard. The disclosure has to be made, and the expense must be on the basis of the actual valuation, not only on the basis of what has been contributed to the fund. Here again, in some cases, expenses for defined contribution have not been totally disclosed. Disclosure of defined contribution plans is compulsory in the notes to accounts. If you have a contribution plan in which the company and the employee may be making a contribution, then such contribution must be disclosed in the notes to accounts. That is a requirement and prerequisite of AS 15. Again, enterprise should use the project unit credit method to determine the present value of its defined benefit obligations related to current service cost. And if it is applicable for past service cost, then also for the past service cost, the expense must be on the basis of the project unit method. So therefore, employee benefits may, if you are using it, you are using the actual report, it must be explicitly mentioned that this has been done on the basis of project unit project unit credit method, and you cannot simply say that services of qualified actuary were used and amounts were done. No, the standard requires that the actuary should have followed this method. Please check the report of the actuary. Look at whether the actuary has used the project unit credit method. You are relying on the work of an expert, but you will also have to see whether the assumptions that have been taken by the company, by the actuary are correct, and whether he has followed the project unit credit method as required under the standard which is expected to them. Again, on gratuity, just stating that provision is made in the accounts considering balance sheet date. No, you will have to prepare an actual report, and based on that, the expense of gratuity will also have to be accounted for. Even if there are termination benefits, those will also have to be accounted for on accrual basis. So, a lot of non-compliances, as one is aware, are noticed by FRRB, especially with regards to the AS 15. I mentioned in the beginning, this is not a standard simply for retirement benefits. This is a standard for employee benefits. So there are short-term employee benefits, salaries and the likes, long-term employee benefits, defined contribution plan, defined benefits plan, and the entire disclosure as required by the AS 15, the actual report that you are getting, ensuring that the project unit credit method is done, that fact should be disclosed in your accounting policy, and the entire disclosures as required under AS 15 must be followed. AS 16, the borrowing cost. Here again, in one of the companies, it was noticed that in the finished goods, it was mentioned that finished goods are valued at cost or NRV. And what does the cost include? Depreciation and interest. Now, AS 16 is very clear that interest cannot be capitalized for inventories. Interest capitalization as per para 5 of the AS 16, it can only be done for those items which require a substantial period of time to get ready for sale. That is to say, more than 1 year is required. It has to be a qualifying asset. Only then can interest be capitalizing. And to include interest for valuation of inventories is absolutely improper and violative of the AS 16 principles. In another case, the schedule of secured loans as well as the related information given in the notes to accounts reflect that borrowing cost was incurred and a portion was capitalized to the fixed asset. So you can very clearly, looking at the balance sheet, make out that there was interest expense. Some amount of it has been capitalized, some amount of it has been charged to P&L account. Yet, in the financial statements, this was not disclosed. The para 23 of A16 requires you will have to show both the accounting policy adopted and also the amount of borrowing cost which are capitalized. So if you have capitalized certain portion of the interest, what amount has been capitalized, that will have to very clearly be distinguished and separately disclosed under the as required under the AS 16 para 23. Different companies are found to be treating debt restructuring charges and external commercial borrowing upfront fees. They are saying, the treatment of them is different. Debt restructuring charges paid to extinguish high cost of debt, which are incurred for acquisition, construction, or production of a qualifying asset. Such costs are not eligible for capitalization because there must always be a qualifying asset. Only on that qualifying asset can you capitalize your interest costs. Such expenses for debt restructuring or for ECBs, even though the amount is substantial, that cannot be construed to be a part of the AS 16. That is not a borrowing cost which you can capitalize. AS 16 does not prescribe amortization of these banking related costs of debt restructuring, external commercial borrowing cost or other such costs. It is only for the interest expense which has to be capitalized or charged to revenue. Those interest expense are dealt with in the AS 16. The AS 17 segment reporting, very quickly I will go through it. As you are aware, there are two segments that the AS 17 describes. One is the primary segment and the secondary segment. So the business segment and the geographical segment. In many financial statements that the FRRB reviewed, we could clearly see that there is an export sale and a domestic sale. So yet the note was that there are no segments identified by the company. Very clear from the basis of the financial statements that there is a secondary segment. The geographical locations on the basis of export and domestic, you can clearly distinguish within India and outside India, and that must be shown as a separate segment, and segment reporting must be done. In cases of the net profit after tax, total assets and total liabilities, which are shown in the P&L and balance sheet, there is significant difference between that and those within the notes of the AS 17. So here the reconciliation statement, the segment revenue should be reconciled to enterprise revenue. So if you have 3 segments, the segment total must agree with what has been shown in the financial statement. Similarly, all other items must be reconciled and measured and mentioned, tallying, agreed with the financial statements. Even today, one is seeing certain financials where the total of the segments does not add up to the enterprise revenue, and that is clearly not as per the AS 17. Like I mentioned, with regards to the export and domestic, there is clear differentials because the risks and the returns of export sales and the domestics are different. The geographical segment can clearly be seen, but it was not done by the management. This was viewed as a non-compliance by the FRRB. Related party disclosures, you are aware, you will have to not only mention the related parties, but the nature of relationship. with them will also have to be disclosed. You cannot simply say other related parties. What is the nature of the relationship of the enterprise with the related parties as required under para 23 of AS 18 has to be complied with. In certain cases, when we were reviewing certain subsidiaries, the holding company or the ultimate holding company, it's a clear related party, yet it was not identified as a related party and the relationship was not shown. It is viewed that the non-disclosure of the names of holding company or subsidiary company is non-compliance of para 21 because there will always be your relative, your related party. Also, para 23 clearly says if you have given any advances to directors, if there is any application money received from KMP for any preferential allotment that you are doing, dividend paid to holding company, all of these have to be, if they are separately given in the corporate governance report, then even in the AS 18 requirement, these transactions have to be reported. Just simply saying that annual report, I have covered these expenses and I will not show them in the related party disclosure, the RPD, not acceptable. Para 23 clearly requires that these related party disclosure transactions must be disclosed in the financial statement. Similarly, KMP disclosures, the managing director, the CEO, who are all clearly appearing to have authority and responsibility. They are KMP and their payments must be obviously separately shown as required under para 18 of the AS 18. Payments and emoluments paid to them are to be separately disclosed. So this deals with the AS 18. Like I mentioned, many other non-compliances that are there, which I will share the presentation with WRC and I'm sure you will be able to get a copy of it. Now, remaining two standards, others are not very commonly observed. AS 20, which deals with EPS. Here, the most common non-compliance is that the basic EPS is always shown. Many companies, when one has reviewed as FRRB, the diluted EPS has been absent. So therefore, it is an expectation that the diluted EPS must be given. If the company has no potential equity shares, then the diluted EPS and the basic EPS is same. But in case of potential equity shares having anti-dilutive effect, then in many cases we have seen that the EPS calculation, the same amount is shown as basic and diluted EPS, which is not correct and is a violation of both para 26 and para 41 of the AS 20. So even if there is no difference, basic and diluted must be separately shown as required as for para 8 of AS 20. And if there is potential dilution that may be there, then that potential dilution must be accounted for when you are calculating your diluted EPS. And finally, I will now discuss the AS 22 because of the shortage of time, and the last standard that I have for today. This deals with deferred tax asset and liability. Many companies have not given the breakup of deferred tax asset and liability. The net amount is disclosed in the profit and loss account. It is disclosed in the financial statement, but the breakup of deferred tax asset, what constitutes the total gross amount of deferred tax asset and what constitutes the gross deferred tax liabilities. For example, there may be certain 43B expenses which may create a deferred asset. There may be depreciation difference between the Income Tax Act and the Companies Act. Those create a deferred tax adjustment. All these should be broken up, and the way in which the net deferred tax expense or the income has been arrived at, that must be very clearly given. In certain companies, the policy is simply stated deferred tax liability and asset are recognized subject to consideration of prudence. This term prudence, like I mentioned in the beginning also, very prevalently used, maybe to at certain places hide certain facts, at certain places to accommodate certain adjustments. The para 15 of AS 22 states deferred tax asset should only be recognized and carried forward where there is reasonable certainty that sufficient future taxable income will be there. So if you are paying MAT, simply recognizing a deferred tax asset or a deferred tax asset in your books is not appropriate. You must have reasonable certainty as the management that you will have taxable income in the future to offset this deferred tax asset recognition. Second, as an auditor also, you must seek from the management its projections for the future and get reasonable audit comfort, justify yourself, be comfortable that yes, the deferred tax asset that I am showing in the balance sheet, the company is showing, and I am giving an opinion as per the SA 700 and the report is being issued, and no qualification or modification as per 705 is being made, then please be assured that yes, in the future, there are sufficient taxable income that will accrue to the organization, which can be used to offset this deferred tax. So with this, I think we have come to the end of the allotted time that was given to me. I hope within this 1.5 hours, I was able to take you through the entire process of the FRRB, the issues that are being looked up, the comparisons that one is doing in the FRRB with the standards, the accounting standards, the audit standards, the guidance notes, the expert opinions and other important publications of the ICI, and most importantly, the standard by standard non-compliances, which even today are being noticed in financial statements. I have been able to describe. I would like to thank once again Ahmedabad branch for hosting this, to WIRC and my dear friend Chintan Bhai for inviting me and structuring this wonderful 2-day session. I think compliments and kudos to him. It's very easy once you're in the leadership position to do programs on income tax and GST, because you will always feel that yes, participation will come, but accounts audit is such a topic that where I personally feel the audit quality in the entire country can only be improved if all of us come together in sessions like this and discuss and deliberate what are the errors, what are the challenges being faced. So once again, compliments and salute to you, Chintan Bhai, for taking the lead and doing this session. Thank you all, wonderful participants, for being logged in and hearing it out. Like I said, the entire presentation, I will share it with WIRC and make it available for you. If you have any questions, you can reach out to me at any time. Thank you once again to Ahmedabad branch and the WIRC.
Thank you so much, Aniket. I think it's always a pleasure to listen to you. And many important issues which are commonly observed you shared. And one of the most important when you start with it was like AS1, discussion of accounting policy. I think when you look at accounting policy in large size companies, so I have seen that accounting policy is not mentioned. Segment reporting is fine, but deferred tax is not there, borrowing cost is not there, investment is not there. So I think this is something which is very critical. We are generally focusing more on only technical fronts, but however, presentation is one of the most important thing in today's world. So we have to be utmost careful when we present these things. Mishra ji, do we have questions for Aniket? Mishra ji, before we move to the next section, do you have questions?
Good evening, Nitin Bhai. Pleasure and honor to have you, sir.
Good evening, sir.
It's always pleasure to have Nitin Bhai, our stalwart personality, and from our C profession to be there. Lalit ji, welcome both of you.
Welcome, Lalit.
Sir, before we go to the next session,
Aniket Bhai,
CA
Nitin Bhai, and Lalit ji, good evening to all of you.
Good evening. Good evening.
Yagnesh, good evening. Yagnesh, we are unable to see you.
मिश्रा जी, पर्दा नशीन कर दिया आपने मुझे.
Can you all hear me?
Yes, sir. We can hear you, sir.
Yes. Thank you.
Okay, fine. Yagnesh, before we move to the next session, we need to have one very important thing which is left. Is heartiest word of thanks to the star faculty who started the session, and he has been one of the most important person, because really the pleasure to listen to you. Very important things he has covered, and the issues which are covered. And one of the most important thing when he focuses on the FRRB, being the chairman of FRRB, when he focuses on the importance of this activity and what is the logic behind that. So FRRB is not something which is to catch you, but it is to support you and hold you to ensure that the quality increases. So I think the very important thing which we come to know from Aniket. So we again thank you by bottom of our heart for sparing your valuable time. We understand that there are a lot of issues are there at this junction, COVID-19, but still sparing your time is one of the most important things. Once again, thank you so much from WSFICI and the branch for coming here.
Thank you so much. Thank you, Chintan bhai. Thank you, Harit bhai. Now, pleasure to be with, share the screen with all the stalwarts. Thank you, sir.
Thank you. Same here.
Yes. Now we have with us the next section, and for the next session is again okay. Acha, Yagnesh, you share this one. Fine.
Sorry?
Yagnesh, we cannot see you. Yeah. Okay, you are there.
Hi, good evening, everybody.
Good evening. Good evening.
Good evening, Yagnesh.
Jayesh, can you please come online? Can you please share your screen photo? Jayesh, Kala, the treasurer of WSF ICI.
Yes, sir.
Yes, yes. First of all, let me welcome all of you to this one of the most important awaited discussions by somebody who is a part of the industry, because we always heard from the practitioners. Now, understanding from the industry is one of the most important thing, and it's really privilege to have the distinguished speakers, distinguished guests of CFOs from very reputed industries. So I welcome CA Nitin Parikh, CA Lalit Malik ji, CA Parag Parikh ji, and our moderator, panel moderator, CA Yagnesh Desai ji, for this session of CFO Panel Discussion. So before I invite Yagnesh Desai to take over the sessions, I request Jayesh Kala, the treasurer of WSF ICI, to introduce the faculty of CFOs and also the Yagnesh Desai.
Thank you, Chirag bhai, Chintan bhai. It's really proud privilege for me to introduce the stalwarts of the industry, and good to see Yagnesh bhai back in action. Nitin bhai Parekh Shri Nitin Parekh likes to be introduced as a lifetime student. He has consistently earned number of prizes, medals, and certificates in several exams. He possesses 6 qualifications like BCom, LLB, CA, CFA, MBA from IIM Ahmedabad, and also MBA in Pharma Management from ICFAI University. Wonderful, sir. Wonderful. हमारे तो पता नहीं शायद कितने साल लग जाते हैं इसको डिग्री को हासिल करने के लिए. In terms of finance qualifications, this would be a rare kind of combination in the country. He secured ranks at various exams. He secured 5th rank in Inter CA and 21st rank in Final CA. He also secured 12th rank in MBA of IIM Ahmedabad. Wonderful. Nitin bhai is serving as a CFO in Cadila Healthcare Limited, the 4th largest pharmaceutical company of India, with an annual turnover of more than 15,000 crore and has 35 years of post-qualification experience. Shri Nitin bhai is recipient of Outstanding Manager of the Year award from Ahmedabad Management Association in March 2021. He is recipient of League of Excellence 2020 award from CFO India. He was declared as the best CFO in healthcare sector for 2012 and also for 2017 by Institute of Chartered Accountants of India. He is chosen amongst the top 100 CFOs of India for 8th time in succession by CFO India. SAP has elected him amongst the top 25 digitalist thought leaders of India for 2015. He has also received Business World Best CFO of India award for award 2017 for healthy balance management of large corporates. He has served on the board of governors of Institute of Chartered Financial Analysts of India, ICFI Business School, ICFI University, and on Accounting Board of Gujarat University. He is presently in the Adani Institute of Infrastructure Management. He has penned a number of articles related to academics and which are published in leading newspaper and he is speaker at several forums, including Big Four firms, Dun & Bradstreet CFO India, IIM Ahmedabad, IIM Udaipur, CA Institute, Cost and Management Institute, ICFI Business School, Adani Institute of Infrastructure Management, Nirma University, etc. He is also a regular speaker at Paryushan Vyakhan. It is indeed our proud privilege to have today Mr. Nitin Parekh Lalit Malik with us. Lalit Malik is the CPA, AICWA, ACA, NLP Journal is an acknowledged leader with over 33 years of varied experience in the field of financial planning and strategy, accounting under US GAAP, IFRS, and Indian GAAP, corporate restructuring, mergers, takeovers, treasury, tax planning and execution, budgeting, corporate governance, risk management, regulatory and compliances, etc. He is currently working with Torrent Power Limited as an executive director and has worked in the past in leadership roles with Dabur India Limited, Moser Beer India Limited, American Express India Private Limited, Procter & Gamble, Gillette India Limited, international experience in the corporate headquarters of Gillette in US, Philips India Limited, and Sharp and Torrent. We are indeed very fortunate to have Mr. Lalit Malik with us today as one of the panelists. We also have Mr. Parag with us, who is an MBA in finance and also attended the senior leadership program with INSEAD University and brings with him more than 21 years of experience in the field of debt and equity finance. He has been associated with various organizations like Gammon Infra Projects Limited, GMR Group, Adani Total Gas Limited. He has experience in various facets of finance accounts with expertise in fundraising management, diversified financial strategies, and operation finance. Mr. Parekh was associated with GMR Group as head project finance and structured finance. He also served as the CFO of GMR Energy. He started his career at Gammon Infrastructure Projects Limited in 1999, and at the time of leaving in 2014, he was designated as Executive Director and CFO. His notable achievements includes financial closures, refinancing and securitization of road and power projects. Besides project financial closures, he also has handled corporate restructuring, corporate finance, raised equity capital via divestments of assets, equity offerings like QIP, private equity, and was responsible for investor relationship for the capital markets. Notably, he was the CFO and spearheaded the IPO in the past. He has completed his master's in both business administration, finance, and commerce. He has also done an executive program in leadership and strategy from INSEAD. We are indeed fortunate to have him also as one of the panelists, Mr. Parag. Mr. Y.M. Desai, another leading chartered accountant. He has been practicing since August 1983, as wide knowledge of audit of corporate and taxation matters, actively associated with activities of Institute of Chartered Accountant. He is an IFRS trainer for certification course of INDES conducted by the Institute of Chartered Accountants, trainer for diploma in IFRS examination conducted by ACCA of UK. He has composed and delivered e-lectures for accounting standard for the Institute of Chartered Accountants of India. He has been speaker on accounting and auditing standards at various seminars of the Institute of Chartered Accountants of India. He has also delivered motivational speeches at various national conventions and student conferences. Between April 2009 till date, delivered 999 sessions and seminars. Probably this will be his 1000th seminar. We are proud of you, Yagnesh bhai. And seminars in about 40 cities across India and abroad. This is 991st section. He has been recently awarded Icon 2020-21 of Mumbai City by Times Group. His hobby is comparing music shows, taken part in half marathon. This is the side which I also did not know. Yagnesh bhai, you are very well versatile person. He is also a member of accounting standard of ICAI. It's really wonderful that today we have eminent panelists, and yes, after seeing the profile of all the three panelists, we can understand that the company they belong in, why the shares are keeping on always rising. It is because of all the efforts taken by all three panelists, and definitely led by Yagnesh bhai, who has aura in itself. और जो वो मॉडरेट करते हैं, it is definitely एक यादगार चीज हो जाती है. So with this brief background, I really welcome on behalf of Institute, I welcome all the three panelists and Yagnesh bhai. Over to you, Chintan bhai.
Thank you so much, Jayesh bhai. I think it's really a pride, pleasure to introduce these dignitaries, because three eminent personalities plus panel moderator, I think they all four deserve a big round of applause from all of us. And one very important thing is that, sir, before I hand over the charge to Yagnesh bhai, I would like to brief you about what we have done yesterday and today. So these are Western India Accounting Conference where we have participation from across Western region, which includes Maharashtra, Gujarat, and Goa. And yesterday we started with the IFRS related global accounting challenges, where the speaker was from Sylvia. She was from Europe. She shared her experience and feeling about the how IFRS is seen in the global market. Then next session was on Schedule 3 amendments, which has been changed effective from 1st April 2021. And today, the third session was by Aniket on commonly observed errors in account standards. So in all these three things, I think we have been primarily focusing from the auditor's angle or from the accountant's angle. But now, one of the most important thing which we all are awaited is to understand your perspective, the way you all have been looking at to and how this will be seen in this COVID-19 situations. So once again, thank you all of you for joining this thing. And now I request Yagnesh bhai, Desai, the panel moderator, to start the process. Over to Yagnesh bhai. Yagnesh bhai,
Some technical connection with Yagnesh bhai.
okay, fine. Till the time Yagnesh bhai join, I think let me just start and keep the ball rolling. And then once Yagnesh bhai joins, then we will go ahead. You all belongs to one of the most important and very important part of the country, because the industries which you are leading is one of the most important industries. And there are question rounds are there where Yagnesh bhai has prepared the questions which are critical and very important. But before we start the question and answer rounds, what we really want to have from you is the opening remarks. So Yagnesh bhai, you're there?
Am I audible now?
Yes.
Yeah, you're audible now. Yes.
Okay. I think there was some connection problem in between, and
Yes.
so I was not able to hear you, and vice versa. So can I now start? Hello.
Please, Yagnesh bhai.
Yeah. Okay. So good evening, everybody, and thank you for joining us in the Western India Accounting Conference on the virtual mode, hosted by and organized by the Ahmedabad branch of WARC of ICAI. And Chintan bhai, I understand that you have taken a very good efforts to make this successful. And thanks our CMCA Jayesh Kalaji for the wonderful words. So Jayesh bhai, when you were introducing the all stalwarts, for the first time in my life, I realized as if I'm underqualified. I first time realized today that I'm an underqualified person, because having seen the kind of achievement, academic achievement, I feel that they are really well worth where they are today. And I must thank all our esteemed panelists for sparing their valuable time and having agreed to be a panelist, and not only that, to share their wisdom, their knowledge with us on the issues concerning that. As Chintan bhai has said at one point in time, that all these seminars normally we are used to hear the chartered accountants who are doing the audit. So मैं कहूँगा कि this side of the table, today for the first time, we are going to be listening and hearing the words of wisdom and their experience about the from the persons who are at the helm of affairs of the company, the head honchos of the company. We always say that the financial statements are the responsibility of the management, and now we are going to hear from the persons who are going to be responsible for the accounting and see that how they perceive certain problems. There's always a difference in the perception as an auditor and when you're sitting on the other side of the table as a management. We'll hear from them today as to how they view the problems, how they perceive the particular situation. So in today's panel, we are going to discuss about the following ideas are going to be discussed about COVID-19 impact on the financial statements and the auditing, and the Schedule 3 changes across Division 1, Division 2, and Division 3, and audit trail and the others and maybe thereafter we have the question answer session. So friends, my dear friends, I'll be firing salvo of questions to you, and I hope you don't mind. And now people are very eager to hear from you from the horse's mouth as to what they are. So without doing too much of an ado, I will now start my first set of questions. The first set of questions is comprised of the or related to the COVID-19 situation. And now we've seen that because of the social distancing, the restrictions of the traveling and all these, one of the most common area which is very intriguing to all auditors is about the inventory. Yes, the auditors now are not able to present at the inventory count. Of course, there are some standards which have taken care of them. But now, Nitin ji, Mr. Nitin Parikh ji, my first question goes to you, and it's like this: how to conduct the inventory count at the locations across the country, specifically in the COVID situation, and how the auditors of the company can be involved to get comfort over the process of the physical inventory. Mr. Nitin Parikh ji, this first question is to you.
Thank you. Thank you,
Over
first
to
of
you, Nitin ji.
all, for inviting to this esteemed, panel discussion and making us part of this. Actually, with more number of years of experience, people get outdated, but you are still considering as worth, this kind of discussion. So thank you for that. So Yagnesh ji, on the inventory verification, valuation part, and auditor's responsibility on that. As you know, SA 500 mentions that auditor is required to get sufficient appropriate evidence in terms of inventory for him to get the comfort while certifying the inventory. Now, given the current context of pandemic and lockdown in certain parts of the country, or restrictions on the movement, obviously it becomes very difficult for auditor to ensure and be part of that process of physical inspection or being part of the counting of inventory. And therefore, I think last year also, institute has come out with a recommendation in terms of the guidance note as to how the
Advisory
for that. And I think the advisory carries out lot many other options available to auditor, apart from obviously there is a possibility of remaining present. That's always the best thing. But in the case that that is not possible, the auditor can then go for various other kind of procedures, including, let's say, somewhere rollback, roll forward kind of procedures, and look at the documents in terms of purchase and sales thereafter. Look at what the management has done, in terms of inventory part, whether management itself has been able to take inventory, and then auditor can get sufficient evidence and trust basis that. Also, internal auditor, if they have taken inventory, their work can be relied upon with the appropriate safeguards. Use of other chartered accountants in the relevant geographies also can be taken help of. And with the help of technology, like in our case, we also used video calling and samples to be drawn by the auditors, and for people specifically showing the specific samples or specific boxes basis the choice done by the auditors, and through remote controlled video virtual way of looking at the verification done by the people at the relevant place. So these are some of the tools and techniques, I think, and obviously more the merrier. That it's not that only you go for this, or some certain places they can go for other chartered accountants work, somewhere internal auditor work, somewhere companies work, somewhere physical verification through remote virtual means. All of these put together, I think, and what is the track record of the company in the past when the auditors themselves carried out inventory valuation, and what kind of discrepancies, if at all, they found, and how management had implemented correction measures, also can come to their rest in terms of getting the confidence in terms of what kind of system company has adopted.
Yeah, that's fine. I think even the auditors can resort to the analytical procedures also, right, sir? And but I want to know from the industry's perspective that what you say is absolutely correct. You can rely on the internal auditors report pursuant to SS 610 and the other auditors. But sir, I want to know that from the perspective of the industry, what do you do to instill confidence in the auditor? And how frequently you're using the IC, information and communication technology, known as the abbreviation of ICT. सर मैं आपसे जानना चाहता हूं कि आप कैसे इस्तेमाल करते हैं न्यू टेक्नोलॉजीज का सर. नितिन जी.
So we use various kinds of tools. For example, even in general also to enable auditors to carry out the audit, we have created a separate portal where all the documents are uploaded at that portal. And
This is very
we have
good.
given
Very good.
VPN access we have given to the auditors. Our SAP system access is given to them. So all our systems are already there. We anyway follow perpetual inventory system. So it's not that inventory is checked once in a while. It's periodically getting checked anyway. On a quarterly basis, 6 monthly also, there are various reports, including the reports where our own management audit team is going to the various locations and preparing reports. Those copies are also made available to the auditors. So there are more than one different ways of getting that comfort level of statutory auditors.
Well, I really appreciate, and you mentioned quite correctly the auditing standard on auditing 501, which says 501.5 paragraph and 5016 paragraph, as if it appears there, and we saved this kind of situation and made a provision for this. So very rightly, Mr. Parikh, you have mentioned this. I really appreciate. But I can see from the body language of Mr. Malik that he wants to say something on this question also. Am I right, Mr. Malik, in reading your body language?
Sure. I think thanks for that. I agree with what Mr. Nitin Parikh has said. In the current environment, due to COVID, where everybody is working from home, and given the scenario that inventory verification is one of the important criteria to determine the control and true and fair view, lot of emphasis is given to have the video recording or using the technological tool, which are in the form of either Teams or Zooms, etc., and having a local person monitoring the inventory and reconciling it with the books, and having a local person there to give the support. And at the same time, like you very rightly said, the analytical tool which can help in terms of variance, can give more confidence in terms of the consistency, and as and when there is an opportunity on a test basis, the physical verification can also support. So I think these are very important I would say changes that are relevant to still adopt, but at the same time give comfort with regard to the true and fair valuation of inventory at all levels. And because all the warehousing and all currently have the camera system for security reasons, I think this is not that difficult to maintain and manage.
All right, Lalit ji, line pe sirf bane rahiye, because the second question is for you only. So stay tuned. I am raising the second question to you, Lalit ji. So Mr. Malik, the second question is that how practical is the inventory verification based on video? Though I know that you mentioned something about that, but still, I want to dwell upon a little more on the uses of the technology and the video. Quite briefly, so please. Thank you.
Sure. So as I just said earlier, I think given the scenario that auditors are also working from home, it is practically very difficult, if not impossible, for them to be physically present. And therefore, since we have the facility of even recording those video verifications, so this can remain as the also the record available to re-verify in case of any further reward that is required. And at the same time, reconciling with the documentary support and also books of records. This can be reconciled, and if there are any other variance analysis can help in terms of ensuring that there is a proper true and fair view. So this, I think, methodology of video recording, I think, can be used very extensively and very effectively to ensure that we still are able to bring in right controls in terms of physical verification.
Right, so thank you, sir. But it looks like that now a chartered accountant need to be techno-savvy also. Correct, sir? So we need to gear up and be techno-savvy. And now the second question is to Mr. Parikh ji. And Parag ji, the question is that what challenges can be faced for obtaining the balance confirmation, which is considered to be one of the auditing procedures and a mandatory auditing procedures from the suppliers, customers, related parties, banks, and lending institutions. I repeat the question: what challenges can be faced for obtaining balance confirmations from suppliers, customers, related parties, banks, and lending institutions?
Thank you.
Welcome on this
Yagnesh.
forum, Parag ji.
Thank you, Yagnesh. And firstly, thank you, WRC, for inviting me for this. A little bit on the backdrop. I think the pandemic, has really, accelerated some of the digital learnings, which any which case, companies, had, and that has helped, in, accelerating. And possibly sometimes, as we say, that when you do not have any other alternatives or choices, you do land up, working towards the most optimal solution in those times. So I think, that has really accelerated the learning for the entire industry. A lot also depends whether it is to do with inventory or balance confirmations. A lot depends upon how robust are your systems. So one, at one degree, you have your own internal management assurance. So how robust are your own systems? Now, for example, be it inventory or be it even in terms of the balance confirmations across different stakeholders, we land up doing this, on a monthly basis. And when you do land up doing on this monthly basis, you already have an elevated view on where you are heading, when you go to your quarterly and your annual closings. Similarly, on top of the management assurance is your internal audit. How strongly, how repetitively are your internal audit procedures being taken? So again, for example, as far as inventory is concerned, even the internal auditor, has been going to various sites, taking help of some of the local auditors. And I think some of my colleagues, co-panelists said that I think digital videography is becoming more and more acceptable. Samples are being taken, and that allows one, to be sure at different points of time that you are on the right path. And third, of course, is, you're overlaying the statutory audit, which is necessary, which is being done on a quarterly and an annual basis. So your robustness of your management assurance and your internal audit actually gives a lot more comfort, even when you are there, when a statutory auditor goes through the same process, that there is an interim checkpoints that are being put. These interim checkpoints are already being verified, and that enables the statutory auditor not only to move in speed, but also as much as in terms of, getting the credibility of the data. Now, in our case, uniquely, Yagnesh, we've seen last year and now we are seeing this year, 2 consecutive annual years, we are actually, doing a virtual annual board meeting. Leave aside the fact that, many quarters also we've done, but last year as well as, we are actually closing our current year on the coming Tuesday. And, when you're doing this, auditors are, of course, remotely available, but balance confirmations largely are, being very, very robust, very much on time, especially as far as, when you look at bankers, lenders, when you look at related parties, to some extent, you look at customers. Suppliers is a very, very open box, because you deal with some of the MSME kind of suppliers, as well as you deal with some of the larger guys. And I think to some extent, the challenge lies on the MSE ones, where, they may not have necessarily the same process, the same systems to work remotely and possibly, give you, these balance confirmations. But coming back, as I said, I think it depends on the 3 layers: your internal management assurance, internal audit, and then, to top it up, statutory audit. If you have this, and which is being done, at possibly periods, much shorter than the quarters and the annual years, I think, that gives a very, very strong direction, confirmations, in the interims also, to make sure that the statutory auditor gets the right comfort as far as closing is concerned.
Thank you, Mr. Parikh. And friends, now we must learn. This is the learning curve for us. इसके लिए तो हम आए, and this is, I would call paisavasool.com for inviting this all gentlemen. We must learn to do monthly reconciliation and confirmation pursuant to SF 505. SF 505 says you do take the confirmation, not necessarily every year. And that's the reason, am I right, Mr. Parikh, to say that you're holding the AGM next week somewhere?
Yes, we are holding the annual board meeting, the annual March board meeting, on the coming Tuesday. We did have a virtual AGM last year.
Adoption of financial for 2021.
That's correct. That's correct.
Great.
That's been done on Tuesday.
No wonder, sir, when you're doing this kind of process on a concurrent basis, you're bound to do it on time. That's great, sir. That's great, sir. And sir, my next question is to Mr. Nitin Parekh, sir. Nitin Parekh, Mr. Nitin Parekh, Parikh, sir. My next question is to do. This is concerning the impairment. Impairment is something. See, whenever there is a COVID-19 impact, the two aspects of auditing comes up anyone's mind. A, inventory observation, and be the impairment, and third is impairment of the goodwill. So I read out this question to Mr. Nitin Parikh. With the recent developments of the coronavirus outbreak, there are both external and internal sources of information. We technically call it the indicators of impairments, such as the decline in the stock and the commodity prices, decrease in the market and the interest rates, decrease in the market share, also interest rate, manufacturing plant shutdowns, shop closures, reduced demand, and selling prices of the goods and services, indicating that an asset may be impaired. So, sir, what exercise you have done or you've been doing for the impairment of the, I would say, non-financial assets? Yeah, because for the financial assets, we have something called ECL, expected credit loss. So this question is very pertinent, and that is for the non-financial assets. It's over to you, Mr. Parikh.
Thank you. So first of all, let me talk in a lighter language. There is a CFO, we like increment and not impairment. But and I would answer this question, Yagnesh, in two parts. That one, I will give a sort of business or a CFO view, and second from pure accounting angle. So as a CFO, I believe that any kind of temporary events do not affect the fundamentals of the company in terms of its prospects. So, for example, if there is a strike, there is earthquake, there is flood, there is fire, even if let's say they're not insured, just for the sake of argument, you don't say that there is impairment, right? In terms of the business part, the business is and going by the principle of going concern, we believe that if the fundamentals are such which can give a sustainable performance for the company, leaving such aberrations, fundamentally there would not be an impairment, unless there is a reason to believe that the new normal is going to have a very different kind of business model, or a different kind of business prospects, or a sort of permanent change in terms of the profitability of the company, which then you obviously need to recognize, and therefore the question cannot be brushed aside. The only thing I'm saying that whether you consider this a temporary or having some lasting effect with the first angle. Coming to the specific accounting aspects, the accounting aspect says that if the carrying value in the books of accounts is more than the recoverable amount of such asset or cash generating unit, then the impairment is required.
You sing it verbatim. That's great.
And what is the recoverable amount? Recoverable amount is, number one, either the fair value, which is the value minus the whatever the expense for disposal of asset, or the value in use. And unless the really question comes that we need to go for what is the fair value, the value in use also can serve the purpose. And in fact, Ind AS 36, which specifically talks about impairment, also mentions about this, that there is no need to look at both this fair value minus disposable cost and value in use. Even one of these you do, that is okay. Having said so, in the current situation where the value which somebody can fetch by selling that asset or business unit may have an impact of the current short-term phenomenon in the market in terms of how market is good for that kind of asset. And this will be also function of a particular sector or company. Let's say if you talk of, let's say, pharma sector versus the hospitality sector, you would obviously find the impact more on hospitality sector, entertainment sector, media sector as compared to healthcare sector. And therefore, that short-term phenomenon in terms of, let's say, reduced prospects of a particular industry should not necessarily be considered as as the value impairment requirement, going by what is the fair value today. Then you can go for value in use, and value in use obviously has many different dimensions. I think if I'm not mistaken, Ind AS 113 also talks about when fair value measurement is talked about.
Fair value measurement.
That how you have hierarchy of level 1, level 2, level 3 kind of fair value, where in the level 1 you talk of quoted values of assets and liabilities, and in level 2 you talk of quoted values of similar assets and liabilities, or in third you go for even non-observable inputs and say, okay, let me find out what are the management forecast in terms of business projections, and you take DCF method of arriving at the value. So all these measures, I think, ultimately help in finding out what is the real fair value, and compared to that, if you find that the carrying value is still higher than that, then there would be need of impairment.
Thank you very much, sir. This is really impressive. You're rattling out the standard name like a CA student. That was very impressive.
That was my introduction. I am a lifetime student.
I know that. That's very nice. And now, Mr. Malik, the second question is to you, and that is also inextricably connected with the impairment, but this is concerning the impairment of the goodwill. So can I read out the question to you, Mr. Malik, please?
Please.
All right. So for carrying out the impairment of the testing of goodwill, intangible assets, how cash flow valuation could be the best made, cash flow expectations and the projections can best be made where the future is uncertain due to the COVID-19. Sir, this COVID-19 has got a lot of uncertainty. It brings along with anything else the uncertainty also, which is inextricably connected and embedded with the problem. So how do you address this problem? And this is very much close to what Mr. Nitin Parikh has said about value in use and all this. And you were nodding your head. So I was about to ask you, but this second question is for you only, sir. So please, it's over to you.
Sure. Sure. I think just again taking forward from what Mr. Nitin Parikh just talked about.
Yes.
So we consider the fair value and carrying value gap in order to determine whether there is any impairment required or not required. And considering the COVID implication, I think you are absolutely right. Lots of uncertainties have come in terms of business. Now, once we look at both on the external side as well as on the internal side, we do not know by when or how long this COVID impact is going to continue. That is one uncertainty. Number two, how the economy is going to revive. That is another uncertainty. Number three, even in terms of customer behavior, if it is going to undergo a change, which we have seen in many of the areas, how that is going to pan out in terms of the demand for the product. And number four, we also need to see the purchasing power in the country, which, we have a big unemployment issue coming up. So these are one external factors. Now, taking those into account internally, we need to also factor in terms of our cash flow implications on account of one, revenue, two, in terms of how the working capital control is going to work out, how the long-term fixed assets investments versus its utilization or capacity utilization is going to work out, and basis which what kind of cash generation or cash flow we can have. Now here again we'll have to look at short term versus long term. Again, to referring to what Mr. Nitin Parikh was talking about, that it may be that in the short run we may have some implication, but long run it may come back to normal. Then the implications may not be to that severe, as long as the gap on the fair value is higher compared to the carrying value is higher compared to the fair value. Now, if it is other way around, then obviously the question of impairment will come in. So in this uncertainty, we have to incorporate the risk factor. We have to factor the external implication and our internal efforts that we are going to take, and basically the best judgment in terms of our cash flows, and then the fair value for our intangible and goodwill, and whether there is any impairment required or not.
All right, sir. Thank you very much, sir. But I must share something here. See, this question was concerning also about the tasting goodwill, but I must share something here with you that I was reading the annual report of the Airbus Industries, both for both for December 2019 and 20, and they have added very interesting element, one of the interesting criteria, and this I think should be of interest to all of us. What they had done, they have compared the market capitalization of the company with the net assets of the company, net worth of the company. And they have given the reason, since the market capitalization is more than the net worth or the equity of the company, it does not warrant the impairment. So I always tell in a clients also, okay, friends, what standard says is to conduct the impairment test. The standard does not say that you do the impairment. Impairment comes into the questions only when the carrying amount of a particular asset is more than the recoverable amount, as both you Sajjan have said just now, right, sir?
Yes.
But
Yes.
somehow don't feel bad about it. But when we talk about the impairment and not the increment, the management looks at this with a fly in the teeth. Hey, sir, impairment nahi karna. I said no, conduct the impairment test. Justified like this. And if you see Airbus being hardly hit, they've seen that they've reduced the number of A320, A380 aircraft drastically low. Despite being there, the company has not the impairment of this. So I think this will really help us to give a new perspective, sir. And this, I find it is missing in the Indian companies' annual reports. The same thing is here with the British Airways and the Airbus industry. Because to read the annual report of the airline industry is my hobby, more so when I'm not able to travel.
And also because
and,
these industries
my
have been
next question-
impacted also.
Sorry?
That's just
I'm
because
saying
you are
that
not traveling,
airline
definitely airline is affected.
Yes, it's affected, sir. Sir, now my next question is to Mr. Parag ji. The impairment of the receivables and other financial assets. Now here I am talking about the ECL model, expected credit loss model. Here I am talking about specifically impairment of the financial assets, which is covered by Ind AS 109/IFRS 9. So, but I must say ECL is one of the most complicated topics. Is one of the most complicated topic. Okay, in terms of the future uncertainty, especially when it is related to the recoverability of the from the clients in certain stressed structures or the stress area. Mr. Parag ji, please, it's over to you.
Sure. Thank you, Yagnesh. I think fundamentally, especially when we look at impairment as a topic, and more so when we refer it to financial assets, including receivables, I think
True.
the key is, how does one look at the credit loss method? By far more than not, auditors, entities, everybody's basic area of dependency comes from historic data. And this historic data is then used in terms of building up a credit loss method. Now these historic data and historic experiences completely fall off when you are in the current times like pandemic, where the future is uncertain, not necessarily as easily predictable as in the past. And I think that is where the challenge becomes even more interesting, because one will need to really start estimating on how and when the recovery will start, how and when the external environment will begin to build up. Like Lalit mentioned a little while back, it's practically impossible for one to really exactly predict or how things are going to evolve. But I think what is important is to have a fair assessment, and possibly depending on different time buckets, presumably, for example, whether if this condition were to remain for 3 months, for 1 year or 2 years. And I think if you look at some of the global studies, if you look at the best of the management leaders, when even we started moving into this pandemic, the immediate thought was a short-term sort of arrangement, 3 months survival, 1 year which is a medium term, and 2 years which is relatively being regarded as a long term. And I think you need to see impairments based on these different time zones, not knowing when really one will come out of that situation. And based on that, once you've seen it from different time buckets, and if you do reach a point after factoring these implications on the impairment, that will, in my mind, give a far more realistic picture on how one should look at the credit loss method. B, I think what's also important along with that is in terms of what are the matrices that you use, especially for say receivables. Now, receivables, may have a certain working capital period, and will that working capital period will really remain the same, or should it really remain the same at different points of time given the pandemic? And I think these are very mature discussions that the entity should have with the statutory auditor to really arrive that, does my entity really require an impairment or not? In my case, of course, ATGL is a B2C company, so we have multiple consumers on the ground. So on one hand, these are very, very small in terms of consumption. But for example, and I'll give you, a few sort of thoughts around it. That, I have a consumer at home for which I need to, collect, the gas consumption which has happened over the last 2 months. So that's my billing cycle. Now, while there's a fair assessment being done in terms of the credit worthiness, the history of each of the customers, all of this actually enables one to really see how impairment should be conducted as far as receivables are concerned. B, I think there are unique things that we keep evolving on. Today, as we started about a couple of months back, a WhatsApp billing. So there's actually an invoice which is going on to the WhatsApp, and there's a pay link being given onto the WhatsApp, and the customer or the consumer is able to pay. Again, as I said, COVID has, or the pandemic has taught a lot of things. Today, while historically we were at digital payments of about 70-75%, we are now almost at 90% on digital payments. So I think there are two efforts to be done. One is, in terms of really from an audit perspective and from an impairment perspective on how receivables should be treated. But at the same point, keeping an eye on the business, that how do I keep managing my receivables in a well-defined manner.
Thank you very much, sir. I was about to ask Mr. Parikh that nowadays people are using the Paytm and all kind of thing, the Phone Pay, Google Pay, all kind of thing, because they get a lot of incentives and points also. So people are very keen to use this. So as you said that about 80 to 90% is by this with the electronic payments recovery.
That's correct. That's correct. So, historically, we were actually at 70%. And two things have happened. One is, of course, marketing interventions, efforts from our side, and incentives being given, for customers to move actually digitally, from a physical process.
True.
And as I said, the last 18 months, of the pandemic has also actually by itself encouraged people to move digitally. So that 70% number today, we are at actually 90%.
Right, sir. So these mark the end of the all questions related to the COVID-19. In the aftermath of COVID-19, what the accounting fraternity is facing. I must say, friends, all of you have dwelled very well and enriched us a lot. So on behalf of all of us, I am at least giving you the clap, okay? Please do. The great deliberation. And now, ab karvat badalte hain and we go to Schedule 3. Now, Schedule 3, there were a lot of changes made across the board, whether it is level 1, 2, 3, or 4. And the best part is that this is applicable from the accounting period beginning on or after 1st April 2021. Because when these changes were introduced, everyone was grappling as to, are we supposed to make these changes for the financial year ending 21? But then this fear was allayed by the clarification from the ICAI and even the MCA that this is applicable for the financial statements for 21-22. Nonetheless, we have to be geared up for the details asked from by the these changes, because we need to give the comparative for 21-22. So the company which is making the confirmation a monthly basis, sir, then naturally you will also gear up for the changes. So my first question about the changes on the Schedule 3 to the companies is to Mr. Nitin Parikh. Nitin Parikh ji, my first question goes about that. They have, let's say, they classified into the project's progress and the project temporarily suspended. About the work in progress, capital work in progress, there is a question, very specific question about that how you need to report the following things also. Just a minute, says, just a minute, please. Capital work in progress has been classified, has to be classified and bifurcated into less than a year, between 1 and 2 years, and 2 and 3 and 3 years and above. And that is classified into project in progress and project temporarily suspended, and the disclosure of the completion where the overdue, wherever is overdue or exceeded the cost originally budgeted. So in this regard, Mr. Parikh, kindly throw some light.
So as you already put in the question, there are three elements to this particular question in terms of capital WIP. One is regarding the projects which are in progress and projects which are temporarily suspended. I think this is very useful information, welcome feature, because if there are projects which are suspended, it may show many different implications for the users of financial statement. If the project is put on hold or is suspended, it possibly means that management does not consider it to be enough attractive in terms of its payback period or other financial attractiveness, or there are maybe some regulatory challenges, permission challenges, or there is an issue in terms of funding that project, whatever, so there are different kind of interpretations possible, and the users of information, financial information, if they are not able to make any judgments, obviously this is at least one area where the shareholders can ask question to the management that why certain projects are put on hold.
Correct.
Why they are
On hold.
suspended. Okay. Yeah, so that is one very important piece of information. Second is in terms of aging. I think aging is also welcome feature for people to understand that why, for example, certain projects are between 2 to 3 years or more than 3 years. So this is also possible because of the nature of the industry or the type of project. There is a project, for example, which will take large some infrastructure projects may take 4, 5 years, 7 years also. Nothing wrong about that, but that would also educate the shareholders in terms of understanding the project durations of different industries where there are shareholders. And over a period of time, if you say that, let's say a pharmaceutical project for regulated market in terms of physical implementation can be done, let's say in 12 to 15 months, and there is a project which is taking now 24 months plus, that gives a ground for somebody to ask the question that why this particular project is not delayed, or is giving time of more than two years. The third part, which is little tricky, though it's a good feature, is in terms of overrun, whether it is a time overrun or cost overrun. Now, obviously, both are significantly pieces of information that if there is a time overrun, it means that in terms of the revenue generation, it will impact the projections, and the cost overrun also will change the payback period for the company. The difficulty possibly in that area could be how many companies would have in the beginning of the period such criteria fixed in terms of what is the all elements of cost of project, the scope of project, the time-wise duration, how accurate would be the estimate of the cost and time. And therefore, I also believe that some kind of tolerance would be required for this particular standard in terms of the information to be given, because I don't think all the companies are actually geared up to have this form. While large companies may be, even large company experience, I will say that there may be project scope change over a period of time depending on new situation, new demand, new regulatory challenges, or the prospects that I wanted to implement project for 10 tons, and all of a sudden I decide to now have a project of 15 tons, 20 tons. We, for example, have announced recently that we will be doubling our vaccine production capacity. Or somebody can say that is this a overrun of cost and time? No, it is not. So I'm saying there will be a lot of need of educating public also in terms of implications, and some time to be given possibly for this cost and time element compared to the first two elements.
Well, do appreciate, but I think, as you said correctly, that we need to educate readers and not just to see that any delay or overdue as something called which is not good or this is a negative thing. So now my next question is to Mr. Malik. Mr. Malik, these are both concerning about the aging of receivables and payable. So I'm asking this question: the aging of trade receivables, again, less than 6 months, between less than 1 year's time, 1 to 2 years, 2 to 3 years, and again the trade payable, same kind of thing. So what do you think these changes are really meant for, and how do you think it will be difficult for the industry to comply with, and what do you think is the real logic behind soliciting this kind of information by virtue of getting additional dose of disclosures? So two questions: A, receivables; B, payables.
Sure. So I think let's look at first of all why the need for having that extra disclosure where they are talking about the age separately. I think what we have seen is that again arising out of COVID to some extent, where there has been an issue with regard to your customers as well as with your vendors. There were cash flow issues involved there, and as a result of it, there have been aging increasing in terms of these receivables and payable. And just to talk about the receivable part, I think one of the important thing when we talk on this parameters is that what are the credit terms that we have both for receivable and payable, and it has to be seen in context with that period. So whether they are due or they are overdue. Now it depends upon the terms that we have with receivable and payable. Now one thing that it talks about is in terms of the aging part. The second talks about being overdue, and if it is overdue, whether they are under dispute or they are overdue for some temporary disturbance purposes. And if it is under dispute, have we created any provision or have we taken any legal recourse? I think these are the clarifications which can help the investors, the stakeholders, the analysts to understand the business in a better way, where you have already shown as an income whether you are likely to receive that money. Is it going to extend and create pressure on your cash flow, or you are in a legal recourse for these matters? Coming to the payable side again, there is also a requirement to pay within the specified time to MSMEs. So is the company complying to the payable in time, or they are getting delayed or default on that front? Are they prompt on that? Second, are they also paying all the normal statutory dues, etc.? And number three, have they changed their credit terms with the vendors, wherein they are taking more credit and helping in terms of cash flow? So I think what is important is, in the current scenario, more transparency certainly helps in terms of getting better understanding of the business performance of the organization. However, when we look at as the corporate, I think it would mean that there would be additional disclosure requirement. So efforts will increase to that extent to disclose. But considering the fact that the corporates do have all the information available, it should not be a major concern, but it is something to help in terms of better transparency and better disclosures.
All right, sir. Thank you. Sir, I'll add one more aspect here. The requirement of division 2 and schedule 3 says that if there is a dispute, also you have to mention about the dispute. And
Correct.
This perhaps, I believe, from the perspective of the IPC, insolvency and the bankruptcy code, because if there is a disputed, if any dues are disputed for the operational creditors, then they are not eligible to file an application for the IPC. So that may be one of the reasons that. I think I could make out from the body language of Mr. Parikh sir. Parag ji, would like to say something? You want to throw some light here, Mr. Parikh ji?
So I think Lalit covered it quite well. The issue, I think, arising out of the importance being given in terms of MSME, and that has resulted in terms of having a separate disclosure for MSME as well as far as non-MSE is concerned. The bigger issue in my mind is that not only the disclosure has to be there between MSME and non-MSME, but also in terms of the outstanding disputes with each of them. And as you all know, dispute becomes a very, very subjective term, and therefore, to take the right view and the balance of what is a disputed payable or a receivable, is a fine balance that one will need to assess, while reporting. But I think all in all, the entire thought process behind, the improvements on Schedule 3 and consequent CARO reporting is really arising out of 2 to 3 things. A, the fact that, there needs to be a better governance, a stronger governance framework, a far more transparent disclosure, to the reader. And here, in my mind, the reader is not just a shareholder, but different stakeholders, who are assessing the business in different ways. So be it a banks, institutions, or a lender, a shareholder or a potential shareholder, or for that matter, anybody else, even, from a corporate social governance responsibility. So I think that's the whole intent behind that. 2-3 instances, in terms of some of the challenges that have happened in terms of avoiding frauds, or for that matter, in terms of, having more responsibility coming out from CSR. So these are the two ends of the experience, which has really, resulted into saying that there needs to be a better governance framework and a better disclosure.
It's not here in the panel questions, but I must also share is one of the information that interestingly, the Schedule 3 disclosure now required disclosure about the cryptocurrencies also. About the cryptocurrencies also, there's a provision for that, and this is something very interesting. And I think we have completed 2 padavs about the COVID and the Schedule 3 changes, and now we are coming to the audit trail, we are lagging a little behind the time, but I think we'll make it up. Okay, sir. Now the next question is focused on the audit trail, and this is with Mr. Nitin Parikh. Sir, I just read the question, and as I mentioned, this is concerning the audit trail. As per the new provisions introduced with effect from April 1, 2022, accounting software used by the company for maintaining the books of accounts shall have features of the audit trail and cannot be disabled. At the same time, that means backdated entries is avoided. What kind of hindrance the company may face during the new requirement? But sir, here I'm sure, Mr. Nitin Parikh, you may have to step down a bit, because the company of your caliber would always must have thought of this much before they have thought. Am I right, sir?
Yes, yes.
Yes. And not your company only, but even I would say the Torrent, or even your companies also, sir. Am I right, sir? Correct. So this must be nothing new for you, because you must have already embedded in your ERP system, maybe the SAP or the CARO or whatever other people software, whatever use, Oracle or. So please throw some light here. Do you think it's going to be? I think there's going to be a challenge for the smaller companies. Am I right, sir?
Yeah, so you are absolutely right, Yagnesh, that most standard ERPs, including SAP, already have this feature of audit trail, where unlike tally accounting, you just can't delete the entry. Okay, so whatever entry you do, obviously you leave the trail. Even if you modify the entry or delete, reverse the entry, that trail always remains. What smaller companies, as you rightly mentioned, may not have their ERP or other systems having this particular feature. And I think since the date for implementation is now 1/4/2022, according to me, I think that the time will be available for companies to either add these features or go for change in terms of system. If the current software suppliers are not in a position to modify their system to have this feature, maybe they will have to go to another system. So there will be some transition, but it's like safar mein dukh to hogi.
I'd like to call a guest speaker here, and मैं चाहता हूं कि शो में हमारे चिंतन जी भी शामिल है. चिंतन भाई पटेल, are you there on the show? I'd like to invite on the floor. Chintan bhai, are you there, sir?
Yes, Yagnesh, I am there.
शो में आपका स्वागत है. हॉट सीट पे चिंतन भाई पटेल, please, what do you have to say about this? Because all three gentlemen were handling this company. For them, it was a matter of history, and there is nothing new about audit trail from them. They have already thought of it and visaged and embedded in the system. Am I right? All three devs,
yes.
all three devs of today.
Yes.
It is a matter of a common thing. But Chintan bhai, I think person like you and me may be dealing with the small and medium enterprises. What do you have to say, Chintan bhai, here? हम आपकी मन की बात जानना चाहते हैं.
Yeah, see, Yagnesh, basically the audit trail, the provisions, if you look at the audit trail which is introduced, it has very important things. One thing, it should be the software should have feature. Second thing, it should capture all transactions. Third very important thing is that it should not have a right given to even top management to disable audit trail for a certain period. So I think the third thing is very critical, and I've seen in the various companies on my experience that in certain cases the top companies also have been given rights that they can disable for few days, 5 days, 10 days, they can disable. So I think this particular provision is actually very important. If you look at out of India, mainly the USA and European countries, this is already compulsory that the accounting softwares cannot provide any option to disable. So one thing is that I think even for large size companies, one has to be very sure that the software cannot provide any features of disablement audit trail. That is a very important thing. And second very important thing is that as we talk about tally and other softwares, as a 1 year period is available, so within that particular period the software need to scale up themselves so that they are able to provide the feature. And if we actually combine the responsibility of auditor along with this, so in auditors rule also they amended, and they have put the responsibility on the auditors to ensure that they need to certify that the software has these features which is again a very critical things for auditors to really test and certify. So for what I foresee is that in the future, the software has to provide themselves a certificate from the system administrator or system consultant that their software complies with the MCA rules. If the software itself provides this confirmation, then all the users of software will be at ease and all the auditors also will be at ease. But yes, as far as medium size, small size companies concerned, if you think from the accounting software perspective, if there are two softwares available in market, one with audit trail, another without audit trail, there will be the 90% clients who will ask for the audit software without audit trail. That is what the mindset in India. So that change in mindset is something critical, because when this provision introduced, we received many questions across the corner. They say, how is possible? If I pass this entry, is it visible? If I do after that, is visible? Everything will be recorded. That is what is required. So the change in mindset, in my view, is one of the most important thing is required, and that will really shape up. It's like, I will say that like camera is there in our offices. So cameras are never been seen where it is being done. But if something happens, the camera will help you. Same way, this audit trail is nothing but a camera in your account software. So it is not going to be supervised every day in, day out. But when something happens, it will be used.
Can I interrupt here? I like the point you brought about the auditors. You know, there's a change in the audit report that even auditors have to even comment upon that. So there's a very good point and perspective brought in by you, Chindam. I really appreciate it. Now you please go ahead. We checked up with Tally company. Tally said that we already have this kind of a figure already embedded in our system. The only thing is that people are not activating it. Tally has this feature. And it's very interesting that at one point in time, Tally was not allowed to market its products in Singapore because it didn't have this kind of editing facility. You know, audit trail was not there. Then Tally has to make these changes, and then only Tally was allowed to be used in Singapore market. So Chindrabhai, thank you so much. Really, as usual, you always add a different perspective. एक नजरिया बदल देते हैं आप, correct sir? But I always tell people, don't worry about the errors. Errors तो होते हैं, errors है. That's why there are specific standards dealing with the accounting errors. Yes or no? Errors have been already envisaged by the standard setters, and that's why the standard setters say that yes, there are accounting policies and rules and regulations and the standards specifically dealing with the changes in accounting policies and the errors. So okay, now sir, we have completed the third pada also, and the last portion is about the other miscellaneous item in all this. Now here, I think we like to hear from you, and this question I would request that all of you please do briefly please throw some light on that, because your companies and whether you're working presently or you have been working in past must have relied heavily on the automation. So my question goes my question: how best the digitization and the automation in accounts and finance function can be done? How safe and accurate it could be, and kindly share the instances of such automation done in your company. हम सुनना चाहते हैं आपसे, क्या तजुर्बा था आपका? What is your experience and how would you advise us going forward? I request all my three eminent panelists to please say in brief about your experience and कुछ हमें हिदायत दीजिए सर. Thank you. Starting with Mr. Nitin Parikh ji, then Mr. Parag ji, two Parikhs, and then Mr. Lalit Parikh.
So I think automation and digitalization are very important for finance and account function, and depending on the maturity of digitalization in any organization, there will be a stage where X number of processes, Y number of processes, Z number of processes would have been either automated or digitalized. So currently in Zydus, we are in the process of commencing Center for Excellence, which is like a shared service center, in-house center, where we are moving various accounting and finance related processes where there are automation tools also, and the most important automation tool, which is mostly the first in terms of choice, is a vendor invoice management. Okay, the automation part of that, whereby the vendors post the invoices on a portal, and the processing is done in terms of workflow, in terms of approval of invoice to be given by the concerned stakeholders, and it goes to the through that digital route rather than the paper route, and the payment gets credited to the party's account. Apart from, there are various processes which we have undertaken where we are automating, including, let's say, bank reconciliation to be automated, and various other processes. We have solved so many workflows in the organization to avoid paperless, avoid paperwork, which is in terms of, let's say, capital expenditure, workflow. There is a purchase order workflow. There is a credit control workflow. If the credit is to be enhanced, to a particular party, and people are sitting across the country, and in the person in let's say Raipur decides that whether a party whose limit is 5 lakhs, can he bill him for 7 lakhs. Okay, everything is then through the authorization matrix, going through that flow, and the decisions are taken. There automatically this audit trail feature is there. Yagnesh, that who approved, for example, the exception to the credit to be given, and the reasons to be recorded, that why it is approved. Okay, so it doesn't then have that kind of ambiguity later on, that if the party ultimately becomes bad, that who initiated, who approved, all these things are already in the system, and therefore you cannot change that. So like that, there are so many other features that we have brought through the systems and automation, and which has a possibility of analysis thereafter. For example, which person in which strategic business unit approved what is the credit beyond the normal standard, and then we analyze that how many of them possibly has gone bad, and that if you make this analysis across various businesses or across geographies, and say who is the better judgment person in terms of going outside the limit, and compared to some other person who is very relaxed and generous.
May I interrupt, Mr. Parikh, Mr. Nitin, may I interrupt? Sir, at the same time, there are the lurking fears of the misuse of the system also, because one, if someone is very smart enough to, tide over certain controls, then he can make the misuse of that.
Yeah, so yes, there are checks and balances, within the system. Balances, yeah, the periodical, checks in terms of how many exceptions are approved by whom, and what is the outcome of that. I think that brings enough of discipline in the system.
Well, I couldn't see Mr. Parag. Parag, are you there, or you just put off your video? Parag, you are there, Mr. Parag.
Yagnesh, there's some technical issue with him. I think you can just go ahead with Malik.
Then I can switch over to Mr. Lalit. Lalit.
Sure. Yeah, I would say that technology is a backbone of any organization, and the way scenario is changing, especially on the COVID side, where people are working remotely, more and more digitalization, especially in finance, is not a luxury, but it is a necessity today. And therefore, keep that in mind, we have gone ahead with and I'm talking more about my past experience because I've just joined in this month. So more on the paperless finance department. We also have done all the automation, like Mr. Nitin Parikh said, all the workflows, rather than having paper approval, are all done digitally through the workflow. It has built-in control and also helps in terms of faster execution and approval, and also trail in terms of how the process is moving. So that has been an advantage. Even in the shared services that we have started implementing RPA, which is the robotic process automation, so that processing is done in a faster way, also in a controlled manner. The other important thing is the finance role is not just to talk about the past data, but also help in terms of future decision-making support. So therefore, the analytical ability through the automation to provide what-if analysis in terms of either a new product launch or price changes, or in terms of demand scenario changes, how can one swiftly adjust to these requirements? And fourthly, how to integrate the external software that are available to get the external data integrated into the common SAP through before SAP data, before HANA that was implemented. So these were the few areas where I think digital has played a very important role to make finance more efficient and more collaborative and supportive to the business scenario. But having said that, one point is very important, that while doing this automation, the data security and data control is extremely important, because we are also vulnerable to the external attack or a misuse or a leakage. So therefore, high focus on the data security and continuous monitoring has also been given a due importance and weightage in these current scenarios.
Thank you, sir.
Yes.
Okay, now we're very happy to see you back in the saddle, Mr. Parag Parikh. Sir, we'd like to hear from you about the automation. Do you want me to repeat the question, sir?
I think his screen is again frozen.
Yeah.
Yeah, it looks like. So we'll come back to you, sir. But in the meanwhile, sir, now you see the digitization is playing a role, and it has now become the order of the day. And you've seen that. I think one of the panelists mentioned about the board meeting taking place on the in the e-platform, correct, sir, and the digital platform. So with the digital mode of conducting board meetings, audit committees meetings, and shareholders meetings etc. Continue. So do you think this should be the normal, a new normal now? Do you think this should be the new normal, including the board meeting, audit committee meeting, and even the AGMs? So do you advocate this kind of change to stay for the longer time?
I believe so. If it does not completely replace physical meeting, I think the frequency would certainly change. If earlier all the meetings were physical meetings, at least I think 50% of the meeting may be physical and the rest may be digital now.
Okay, okay. What about your opinion, Mr. Malik, on this? What's your say, Mr. Malik, on this?
Yeah, so I think it is a very positive move in the current environment, because it really now is not dependent upon being physical present, and one could connect and have the board meetings or the audit committee meetings, and you get it recorded also, so that the trail is also available on that. Coming on the shareholders meeting, earlier it was only restricted to a particular venue where the selected number of people were able to, or shareholders were able to attend. Now with this, shareholders can be anywhere, whether in India or even abroad, and they can connect and attend that AGM. I think that has been a very positive benefit of the AGM being digitalized. I think we should continue. I think as per requirements, even current year they've allowed the AGM also to be continued.
Yeah,
on.
they think the SEBI.
But hopefully, I think if the option is given to the corporates to do it, if it is not mandatory, I think this will be a very positive move going forward, where lot dependency on digital and make it more efficient, and also reaching out to the larger shareholders can take place. So I think it is a very positive move and should continue in my view.
It is indeed, no denying about it, but that's fine. So now there was, I was waiting for Mr. Parikh to come back, but then now there's one more question again related to the technology only. Sir, many companies are talking about work from home and all kind of thing. Sir, I would like to hear from you that how your company has handled work from home scenario. I mean, I would like to hear from both gentlemen, Mr. Nitin Parikh ji and Mr. Lalit Malik ji. But in the meanwhile, Chintan bhai, the last 10 minutes we have earmarked for the question and answers, right? So are there any questions, Chintan ji?
Yagnesh, we can go ahead. I will just check it out. Question is there or not. Just go ahead.
All right. Okay. So in the meanwhile, please, I mean, we want to go ahead with this. So I would again to repeat the question: how work from home scenario has been handled by you, and if you can give us some tips to the other people, we really appreciate that. And I want to answer from both of you, sir, please.
I think our company has handled work from home quite reasonably well. As you would be aware, as a pharma company, even during lockdown, we were allowed to, operate our business operations and run our plants.
Correct. Essential services.
Where the physical presence somewhere is required, there is obviously you can't do away with that. But most office and other functions were in a position to operate from home. Just now, if I say that my office, though it's otherwise functioning, we have not asked any people to come to office. Is completely voluntary, and in fact, we are discouraging. We say not more than 20% people should be attending office. Just as though we have a very large spacious office being in Ahmedabad. Where the naturally social distancing can be observed, but as a precaution, we are still, not encouraging people to attend the office. We have all our people, with laptops, so that really helps, rather than desktops, right? We have Office 360, and therefore, because of that, we are on that, cloud model. and therefore the physical infrastructure is not required for this purpose. We have tools like MS Team, which we implemented before 2 years, and that actually has become a backbone for our communication these days.
Today, yeah.
Not only board meeting, other things, but all our internal meetings, all monthly review meetings, everything is going as if there is no change, but everything is on MS Team. All the meetings take place in MS Team, and we have been doing various transactions, activities, projects. Everything is possible, and we have not found any challenge that because we are not physically able to meet or be in the office, this work is getting held up. We have not experienced that. I think therefore the technology has really made this very important change and become a boon.
All right, sir. Mr. Malik, I would come back to you, but we were missing Mr. Parag Parikh ji. So I just hand it over to Parag Parikh ji. Sir, it's over to you. We were missing you. Thanks.
Sure.
Nice to see you back.
Sure.
Nice to see you
So
back.
I think two things. I'll try and address firstly a little bit on digitalization, and then addressing it towards
Yes.
work from home. So I think we actually have a very, very strong shared service system. We actually implemented 6 bots. We have already about 85 processes which are under automation. So I think some of them which were mentioned a little while back, whether it is vendor invoicing, whether it is in terms of bank reconciliation, all this is being automated. And with these 85 processes and a continuous process of adding more and more, that's helping in terms of digitalization becoming the backbone as far as accounts are concerned. We've also initiated a project which we have coined it as analog to digital, and the intention behind this is that every process which is actually being done on a non-digital manner is actually being mapped and SOP is driven, and then we are assessing that how and is it possible for one to move digitally on this. So at constant stages we are trying to see more and more manual processes moving into digitalization, and as I said that enables both accuracy as well as in terms of time, speed and reliability. Moving on to the second question, I think and in this context of digitalization and then moving to work from home, I completely concur with what Nitin said. I think Microsoft Teams and some of the other apps have become the backbone, and everybody has a device at home, and we are supporting every employee, whether it is in smaller things like say connectivity. If anybody is struggling, we are making sure that every individual is geared up with all of this, and therefore it is available completely for him to be working from home. So like now it's voluntary. People only are encouraged to go only if they really believe that they need to, but everything is today functional from home, and it's business as usual. So I think the only difference is the number of phone calls have gone down because Microsoft Teams itself becomes your phone call. But I think otherwise everything is remain as same, businesses as usual. And I at least possibly have not seen anything really getting affected with the technology and the digital strength that has been the backbone for many of us.
That's nice. Now it's over to Mr. Malik, please.
Sure.
Share your views.
I think I echo of my colleagues here that I think work from home initially, maybe last year when it started, it was a learning curve for many. But I think in the current scenario, as we talk, we are still work from home is going on as far as the corporate offices are concerned. So I think it is working very well. I would go on the other extreme to say that I think it has become much more disciplined in the sense that now you have a start time of meeting and end time of meeting, and it has become more productive because now you have a specific pointer to discuss, take decisions and move ahead. So I think that if we can use it well, I think it can be a very good improvement or more efficient to take it forward. And plus, I think the physical distance is almost being done away with, where people used to spend time in traveling or commuting, etc. So that is also a saving that's available. And plus, I think health and safety of employees is very important. So keeping that in mind, it is also meeting that requirement where work from home is working very well. I would also stress upon the fact that when it is done, I think to the point earlier, that it is important that people have adequate connectivity and at the same time, but at the same time, we also ensure that there is a proper security system in place. Because I think when more and more people work from remote, there is always a possibility of a leakage or the breakage that can happen. And therefore, the emphasis on enhanced security mechanism is also taken place, and that is helping us to be more comfortable with the remote. And I think this is going to be kind of a new normal till the time it becomes stable. I think, and people will take the advantage of working from home in a more efficient.
Sir, I mean, I could find one common elements amongst three of you, and that's your concern about the employees. And I can see from even whether Nitin, all three companies have very much concern about the employee security and the welfare, and they are seeing more from the perspective of the cost cutting or anything else rather than anything else, employee security. And that's, I would say, all of three you deserve the kudos for that, compliments for that, and really appreciate. This is an indirect and sure mode of discharging the corporate social responsibility, though not envisaged by any act or as such. And so that I think I'm done with all the questions. But before that, I would like to hear from each of you your concluding notes, because I wanted to say something in the outset, but I forgot it. Please excuse me for that. But I would like to hear from you what message you'd like to say, or just your opinion. I mean, just be free and say your man ki baat. Okay. Convey some message for us, or what do you think of this this forum and the panel discussion, and what should be the good? Give us some thoughts of takeaway. Because you all three of you are ultra successful in your field, so you'd like to hear some message, some words of wisdom from you, or whatever you feel like. It's
So
totally
when I
free.
was
There's no question. It's totally free.
Yagnesh, when I was doing my CA in 80s, in the Companies Act we read about directors' duties and trusteeship role, right?
Ji haan.
I think this trusteeship role is what is becoming more and more demanding. When the disclosure and transparency are talked about, I believe it is going to remain unidirectional, because the norms are going to be more and more stringent also in times to come, to remind the people at the helm of the affairs about their duty as a trustee managing money, which is not there alone. It's of shareholders, employees, other stakeholders, including government and society at large. And therefore, you talk of ECG, talk of sustainability, talk of business responsibility, talk of CSR. What are all these? Is to recognize the role and contribution of several stakeholders in the business enterprise. And therefore, in times to come, I think this is a journey, and this journey is in one direction. You should never expect it to come down. You only go up, go ahead. Okay. And what it means that in times to come, more and more disclosure and more transparency expectations would be there. And it's important for the auditing and accounting profession to get geared up with tools, techniques, skills, and a mindset. And I think mindset is most important in that.
Okay. So now, Mr. Malik, it's over to you, or Mr. Parikh, whoever you want to, please.
So I'll just say that one thing is very important that we have learned is that the only permanent thing is a change, and it is important that we all focus on converting challenges into opportunities, and to the point that we need to continuously, apart from the business growth, also focus on ESG, which is environment, social, and governance. And that's what I think is going to be a future, and we will all make sure that we convert challenges into opportunities.
Thank you, Ji. Mr. Parikh, Mr. Parag, Parikh, how would you say? Because Parikh and Parikh very rhymes well.
So just to sort of concluding thoughts, I think it's very important that that from a fixed mindset, I think we all move towards a growth mindset. And when I say growth mindset, it is about continuously adapting change, continuously learning, and persisting with the challenges that are on hand. And I think the last 12 months has actually taught us that when it comes to accounts, when it comes to our function as finance, I think things have been business as usual despite all the challenging circumstances around it. And I think all that answer to that is while digital technology and all are the key pillars, but I think the key is to have that growth and an open mindset to adapt to the changing circumstances around us.
Thank you very much, sir. Thanks to all of you. Now, before the official vote of thanks is being pronounced, It's my duty to say शुक्रगुजार हैं हम आप सबके. Thank you so much, friends. And I must also say one more thing, sir. पर्दे के पीछे की बात करता हूँ कि there are technical personnels who are also helping us a lot. And they are, एक हमारे है मिस्टर मिश्रा जी है, एक हमारे मिस्टर वैभव है, दूसरी टीम ऑफ WRC है जो इनके मैंडेट संदेश जो है उनका ऐसे पालन करते कि बात मत पूछो. And चिंतन भाई, once again, Chintan and me are very good friends, and we had gone overseas many times, and we really had a good time. So what we repent about the COVID is that जो आत्मीयता होती है ना, जो warmth of meeting person में, that we are missing a lot. Okay, once again, thanks everybody for a wonderful, and believe me, what a cooperation by you all. Dot 6:30 we concluded the session, sir. Appreciate that. Chintan bhai, once again, आपका शुक्रगुजार हूँ. Thank you so much. Now it's over to you.
Thank you so much, Yagnesh bhai. I think the credit goes to you and all of the panelists to ensure the timelines, because I was knowing from beginning that when I'm dealing with the top most persons of the companies, they are so much accurate about timings. So timing is never an issue when I'm dealing with all these people. So when we started with the COVID challenges and when we end, I think we can look at many positives. And one of the most important change, one of the most important learning for all of us, including me, is the positives in COVID-19. Because when you've been speaking
Not the
that
positive report.
Yeah, positive reports,
Positive
and one of the most important things is that you all are saying that this is going to be new normal, and you all are enjoying to have work from home, or you feel that all work can go on without any hesitations. Work are being done better than earlier. So I think this is something which is very new, and I think we all have to learn, because if somebody says that they are unable to use work from home, if they are unable to do this, that means we need to improve. So when the three large companies are saying that they are able to do many multi-locations across India, across globe, they are able to handle, then for a small business company, it's definitely possible. So very good positives, very good learnings which we have received from all of you. And I think with this, before we end, there are a few questions here. Yagnesh, can you please just go through questions and then we can get it the answers?
Okay. Now the first question is concerning the goodwill and on consolidation. I'll read out the question. The company was acquired at a premium, and goodwill on consolidation was recognized. Over the years, the business of the subsidiary, it was mainly the service business, moved to the holding company, not by way of any scheme amalgamation, but in a very subtle manner. That's what I understand. And now the subsidiary does not have any business other than the shareholdings of the company as acquired prior to the subsidiary, having value much higher than the investment price and the goodwill. Whether the goodwill on consideration need to be impaired, since there is no business left in the subsidiary, investment in holding gets eliminated in console. So Chintan bhai, you want me to answer this, or you want me to bother the Hamare Tridevs ko?
No, moderator is the best person to answer.
Exactly.
चलिए मेरा सौभाग्य है कि मैं उसका उत्तर देने को सक्षम हूँ and happy to answer. So my dear friend, this is a clear case of the impairment. And I would say that one of the requirements of the, now this is governed by even IAS 36, and they say that when the investment in subsidiary is concerned, there is one specific guidance given under IAS 36, and that is as under. So my dear questioner, please ध्यान से सुनिए मुझे. When the net asset in the consolidated financial statements of that particular subsidiary is less than the investment in the standalone financial statements, this is the clear case of indication of impairment of subsidiary. Now I know we all chartered accountants believe in numbers and figures. Sorry, more the numbers. Okay, so if the investment in standalone financial statements of subsidiary is say about 1 crore, investment in standalone of a particular subsidiary about 1 crore rupees. And the net asset of this subsidiary when consolidated, as you know that when we prepare the CFS, the investment in subsidiary gets knocked off and is replaced by the net asset of the subsidiary. Now the net asset of the subsidiary, let's take two cases. Investment in the standalone is 1 crore. Scenario 1, net asset of the subsidiary is 1 crore 10 lakhs. Impairment is not warranted. Second scenario, the net asset of the subsidiary is 90 lakhs. It is not warranted. So it all depends on facts and circumstances, but this could be one of the indicators of impairment. And I always maintain that if there are indicators of impairment, आप impairment कीजिए, उसे कतराइए मत, because impairment has to be done only when certain parameters are complied with. The second question, in cash flow, whether the full figures of exchange differences to be adjusted, unrealized, or differences adjustment will do. Now this question has got nothing to do with the value in use or something like that, but if I'm not mistaken, my dear friend, in cash flow, whether the full figures of cash exchange difference to be adjusted or unrealized, I'm not too clear about this question, but I can tell you one thing: if there is a exchange difference on the year-end holding of the balances, then it is to be presented as a separate line, and it will not form part of any of the activities of rating, financing, and investing, but rather shown as a separate line. What I am telling you is the exchange difference on the year-end balances. And again, Chintan, आप उम्र में मुझसे छोटे, but फिर भी मैं आपकी नॉलेज की अहमियत रखता हूँ.
Yagnesh, I think you pointed out perfectly well, because I think on closing balance, if we have closing balance which is in foreign currency, we need to provide reconciliation of closing balance in foreign currency from that to the foreign exchange. That is point number one. And as far as the like talking about operating activities, so when we move from indirect way of presenting cash flow statements, so we start with the profit after tax from in P&L account. So from that, whatever the unrealized part is there, that is to be added here.
Correct, sir. So it in a nutshell, it doesn't form part of any of those three activities, but rather as a separate line item at the end of all this. Now the third question, and perhaps last, as far as the work from home is considered, we have over the lockdown period realized that work from home is not a limited or timely affair. Moreover, it overruns the regular working hours, and most of the time, of course, they don't deny the commitment. What can be the way to manage the work from home and the work for home as per the dignitaries on the dais? As far as when I heard these three dignitaries on the dais, the common element was that they never say that we exploited our employees and made them work beyond the working hours. Am I right, sir? I am being the super iconic personality for you. You know, I am just becoming. So I don't think I never heard that we made work employees till 10 o'clock and our company has made the huge savings. None of them has mentioned about the cost savings, exploitation of the employees, all that they were saying time and again, and kept on reiterating, yes, we had cared about the employees' security and welfare.
Having said
all of you, please.
I will just add work-life balance and work from home. Both needs to be in the common balancing part.
Yeah. So it all depends on employer.
According to me, work from home has not changed it. So it depends on whether you first consider work as your worship or love, or you consider work as a boredom. It doesn't change. You know, for example, my office hours are from 9 to 6, and even today, I am in my work home office, in my office currently where I'm talking, which is my home office. I sit in this chair not later than 9 a.m. every day. Okay, it's as good as my going to office only. And in my normal office hours also, you know, it was like instead of 9 to 6, I may be working from 9 to 7:30 or 8, and that continues at home. So I don't think work from home is changing that. I don't think employers want that just because you are at home and you are saving on travel time, so much additional hours you are expected to give for office. No, I don't think any management expects like that.
That's true. Even in fact, I always tell my team members, okay, look, today is a Saturday. Look, it's over now, because you know, काम तो चलते ही रहेगा, sir. One is to put a balance to it. So thank you very much, all of you, really. And I hope, Chintan bhai, we've taken care of the questions. Now I think Abhi, now the vote of thanks. It's over
Yeah,
to you,
sure.
sir.
Yeah, Yagnesh bhai, I think a lot of questions you have already thrown upon. So I was just wondering that which questions are left. And when I look at the questions, only 2 questions or 3 questions, it means that many questions you already covered. And the panel discussion has been fantastic, fabulous. And
No
one
denying
very
about it.
yeah, another important learning which is here is that because schedule 3 when come to picture, there are apprehension about the number of additional disclosures. But when I was listening to all these 3 panel discussions, they were never mentioned about the voluminous disclosure. They just mentioned one thing: it's good for transparency, it is good for
Yes.
governance. So I think that is a credit goes to all corporates, because even if there is a substantial increase in disclosure, they are taking as positive things, and they are ready to provide information to stakeholders. And that's what we are moving towards of era where the corporate governance, transparency, and disclosure is the new norms. So thank you so much, all of you. It's my really my special thanks to each one of you, because you have really accepted my request, because it's always apprehension in our mind that so much big personalities, very busy personalities, whether they will be able to spend time or not. But it's really priceless to have you all are there to serve for ICI, to provide your knowledge and experience to the fraternity. And I request Sunil Bhai is a treasurer of the branch. I request Sunil Bhai to provide hearty follow-up for thanks.
At least Chintan bhai, हम तो तालियां बजाते हैं उनके लिए. Okay, please clap for that.
Thank you, Chintan bhai. Yes, Yagnesh bhai, before saying me the vote of thanks, let's have a big round of applause for all the 3 experts.
Yes, they deserve it. Well
On
deserved.
behalf of WIRC of ICI, I'm thankful to all the 3 learned panelists from big corporates, CA Nitin bhai Parekh, CA Lalit bhai Malik, Shri Parag bhai Parikh, Moderator CA Yagnesh bhai Desai for saying the Man Ki Baat, RCM Chintan bhai Patel, and all participants. It was very wonderful panel discussion on challenges faced for the finalization of books and audit due to the limited resources, manpower, without physical verification of inventory and assets. The alternate method suggested for the video recording for the physical verification to rely on internal audit reports and specific focus on how to maintain the audit trail. Sir, we have noted all the key points that take away from the discussion, and it will helpful to all the participants. Sir, we would like to see you again in future again on this forum, and thank you very much before ending the session. Once again, thank you. And sir, now we are ending the session.
जी हाँ भाइयों बहनों, आप त्रिदेव के आने से बाहर आ गए.
Thank you.
Thank you.
Thank you. Stay safe.
Thank
and
you.
stay
बाहर आए.
Sure. Thanks so much, Yagnesh bhai, for a wonderful panel discussion, because without that it won't be possible here. So thanks to and thank you to all participants, because
Yes. Well done, Yagnesh bhai.
Thanks.
Yeah.
Thank you. Stay safe. Stay healthy.
yeah.
Yes,
Thank you.
all of you. Goodbye. Thanks.